Good afternoon. This meeting will come to order. This is a public meeting of the Commodity Futures Trading Commission. I'd like to welcome members of the public and market participants, as well as those on the phone or watching our webcast. I'd like to welcome my fellow commissioners at this time, Commissioner Quintens, Commissioner Benham, Commissioner Stump, and Commissioner Berkovitz. As always, we'll begin with the Pledge of Allegiance. I'll lead, and anyone is welcome to join. I pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Liberty for all.
Today's open meeting will consider two important matters arising under Part 23 of the CFTC's regulations. First, we'll consider and vote on a final rule establishing capital and financial reporting requirements for swap dealers and major swap participants. Second, we'll hear a staff presentation on two proposed rules concerning margin requirements for uncleared swaps. While the Commission is not ready to vote on those two margin rules, given this week's focus on the capital rule today and our cross-border rule tomorrow, the staff presentation will nonetheless assist the Commission as we consider those proposals in the next couple of weeks in our seriatim process. But we're holding the presentation publicly today to be as transparent as possible about what our Commission is doing. Clarity is one of our core values, and we're serious about it. We'll now move to opening statements. I'll go first, followed by my fellow commissioners in order of seniority. Commissioners are free to reserve their time to make a longer closing statement if they wish. So now I'll begin. This is Chairman Tarbert. Today is a milestone. We're now a decade and a day since the Dodd-Frank Act was signed into law. Much has changed during the past decade. Our derivative markets today are faster, increasingly digital, and more deeply connected to the global economy than they were in 2010. Yet amidst these changes, there's been at least one constant: the absence of capital requirements for swap dealers and major swap participants for which the CFTC is responsible. To guard against systemic risk, Section 731 of the Dodd-Frank Act charged the CFTC with establishing margin rules for uncleared swaps, as well as capital and financial reporting requirements for swap dealers. While our margin rules are nearing the end of their phased implementation, the Commission has yet to finalize capital and financial reporting requirements. Today, we're called to close the book on our Dodd-Frank Act duties by finalizing this rule and fulfilling our statutory obligations. We owe it to market participants who rely on us to provide regulatory certainty. Certainty is the bedrock of our strategic goal as an agency, which is Strategic Goal 3. Enhance the regulatory experience for market participants at home and abroad. Our swap dealers can't effectively plan for compliance without clarity from us about what their capital obligations will look like. Certainty aside, today's final rule, in my view, is good for our markets. It's designed to mitigate systemic risk and enhance customer protection. Capital, in particular, advances these goals because it's the ultimate backstop, ensuring that the financial system remains sound and customer funds are protected in the event all other measures fail. While our uncleared margin rules have effectively absorbed the shocks of recent pandemic-driven volatility, capital requirements are needed to provide further assurances that our markets can weather new storms. So in other words, they may be late, but the good news is they're not too late. In addition, we must acknowledge that our derivatives markets are vibrant because of the diversity of our market participants. Our rules should reflect the breadth of our markets through well-crafted and thoughtful solutions. Of the CFTC's 107 provisionally registered swap dealers, 55 will be subject to the CFTC's capital requirements. Some of these swap dealers are registered future commission merchants, or FCMs. Others are duly registered with the SEC as broker-dealers. Some are subsidiaries of banks, and still others are agriculture and energy businesses. Finally, we've got some that are subject to the jurisdiction of a foreign regulator. Today's final rule accounts for these differences through three approaches to determining minimum required capital for swap dealers that are not FCMs. These three approaches to capital reflect the different statutory foundations, risk profiles, and balance sheets of our swap dealers. I also want to express my support for the final rule's financial reporting provisions, its approval process for market and credit risk models, and its substituted compliance methodology. All these provisions are designed to lift unnecessary burdens, harmonize regulations where appropriate, and provide swap dealers with flexibility in complying with our rules. Accordingly, I'm pleased to support them. And with that, I would like to recognize my fellow commissioners for their opening statements, starting with Commissioner Quintens.
Thank you, Mr. Chairman. This is Commissioner Quintens. First of all, I would like to associate myself with your opening statement. I couldn't agree more about the diversity of our markets, its participants, its products, and how important that makes ensuring that we have very well-calibrated rules to account for the differences in the risks of all of those things put together. As you said, Mr. Chairman, 10 years and 1 day ago, Dodd-Frank was signed into law, and I'm going to be proud to vote for today's final rule, which in my view is the capstone of the CFTC's work to appropriately calibrate those post-crisis reforms. Capital ensures that firms are able to continue to operate during times of economic and financial stress by providing an adequate cushion to protect them from losses. And just as important as the safety and soundness is of individual firms, capital is designed to give the marketplace as a whole confidence that any given firm has a high probability of surviving the next crisis. But capital requirements also create important incentives that drive market behavior. The cost of capital may be the most determinative factor in a firm's decision to remain or become a swap dealer, or to continue to provide clearing services to clients in the case of a futures commission merchant. If capital costs are too expensive, firms will restrict certain business activities, end unprofitable business lines, or in some cases, exit the swaps or futures markets altogether. As a result, over time, the swapped and futures markets would become less liquid, less accessible to end users, more heavily concentrated, and less competitive. These are not the hallmarks of a healthy financial system. And this is why I've always regarded the finalization of capital requirements for swap dealers and FCMs to be the most consequential rulemaking of the post-crisis reforms. I'll have more to say from my statement on the rule during our actual dialogue on it. But let me just, close my opening statement by saying, Mr. Chairman, one of the things that you did when you came to this agency was establish a mission statement and vision statement and a set of core values for the agency after consulting with us and the distinguished employees of the agency. And our vision statement is to be the global standard for sound derivatives regulation. Not only do I think that this rule in front of us is sound because of the calibrated approach that it takes, but I think in order to be the global standard, we have to commit to continually recalibrating things as important as capital should market events and dynamics and the impacts of these rules show us and give us data that makes it important to revisit these decisions. And I think that kind of process and a commitment to that process really helps to enshrine us as the global standard for sound derivatives regulation. Thank you very much, Mr. Chairman. With that, I'll reserve the rest of my time.
Thank you very much, Commissioner Quintens. Commissioner Benham.
Thank you, Chairman Tarbert, and good afternoon to everyone who's listening and able to join us for this important open meeting. Mr. Chairman, I will use this time to give a brief statement and then close with a longer statement towards the end of the rule proposal and the meeting. Questions and concerns about the COVID-19 virus have rightfully dominated headlines and pervaded our daily conversations dating back to the first weeks of this year when there were still so many unknowns. How severe was it going to be? Why are some people impacted more than others when they are infected? How exactly does it spread? And of course, when we'll be able to resume our normal life? And what will the new normal be? We may not know the precise answers to many of these questions until well after the pandemic has passed. But in the meantime, the rapid exponential spread of the virus seemingly evades a complete understanding of how we can address and mitigate the risk it poses to the population in the near and long term. Over the next 24 hours, the CFTC will consider two major rules that target the heart of post-2008 financial crisis reform. Unlike our limited understanding of the transmission of the COVID-19 virus, we do have the benefit of hindsight in understanding how risk spreads in global swaps markets. The 2008 financial crisis made clear that, in many cases, risk deriving from activities in non-U.S. jurisdictions can seamlessly enter, embed in, and infect U.S. markets. We also understand that undercapitalization greatly increases the impact of economic shocks. Yesterday marked 10 years since Congress passed Wall Street reform, a swift legislative response to the financial crisis and ensuing Great Recession, which wreaked havoc on Main Street America and the global economy, in large part because of undercapitalized financial institutions. We must keep these hard-learned lessons top of mind as we refine the tools we use to prevent another crisis of that magnitude. Some may suggest that our efforts over the next 24 hours will finally close a decade-long chapter on financial reform. However, we must not forget that although timing matters, substance equally matters. How we do things is as important as when we do things. This afternoon, the Commission is voting on a final rule that establishes minimum capital requirements for swap dealers and major swap participants who are not subject to a prudential regulator. Although the rule under consideration this afternoon is the first time the Commission will be voting on a final rule for capital requirements as clearly prescribed by Dodd-Frank, there have been multiple iterations of a capital rule dating back to 2011. Congress's 2010 response largely incorporated the international financial reform initiatives for over-the-counter derivatives laid out at the 2009 G20 Pittsburgh Summit, aimed at improving transparency, mitigating systemic risk, and protecting against market abuse. One of the major initiatives in the G20 statement was the imposition of higher capital requirements, quote, to make sure our regulatory system for banks and other financial firms reins in the excesses that led to the crisis. To rein in those excesses, the G20 leaders agreed to raise capital standards. The G20 leaders said unequivocally that for over-the-counter derivatives markets, quote, non-centrally cleared contracts should be subject to higher capital requirements. There's no question that Congress had this same goal in mind when enacting the Dodd-Frank Act a decade ago. Tomorrow morning, the Commission will vote on a separate rule that reduces our ability to exercise jurisdiction over cross-border activities that have a direct and significant connection to activities in U.S. markets. In 2013, the Commission issued interpretive guidance and a policy statement to address the extraterritorial application of the Title VII rules, which has achieved the goals set out by both Congress and the CFTC. In the wake of the financial crisis, Congress entrusted the CFTC with overseeing all swap activities that have a direct and significant connection to or effect on U.S. markets. And we must not abdicate this congressionally mandated responsibility. Last December, the Commission voted to propose to discard this existing guidance and the use of agency guidance and non-binding policy statements altogether in favor of rules implementing a purely risk-based approach. Focusing on our expertise and resources on these entities which individually may pose systemic risk to U.S. markets means that many other entities that are smaller in relative size, yet able to generate and transmit significant risk, can evade oversight and may ultimately carry risk into U.S. markets. Regardless of their size, such entities can individually or in the aggregate affect and negatively impact U.S. financial markets. Just as the least restrictive parts of the country directly impact how rapidly COVID-19 spreads in the rest of the United States, so too will the jurisdictions with the least regulatory oversight of swap markets directly impact the riskiness of U.S. markets. As we collectively work to navigate and resolve a global pandemic that has harmed both the U.S. and global economies, it's important that we as financial regulators remember what we learned from the 2008 crisis and remain steadfast in our support and advocacy for robust reforms. These reforms in many respects, shielded our markets during the worst of market volatility of the COVID-19 pandemic back in March and April, and will certainly do the same in the future. Grateful to the work that staff did to prepare these rules, both for this afternoon and tomorrow, and I look forward to hearing more from the teams. Thank you, Mr. Chairman.
Thank you very much, Commissioner Benham. Commissioner Stump.
Thank you, Chairman Tarbert, for bringing the Commission together again, albeit remotely. I'm very pleased to be participating in today's meeting, and I want to take the opportunity to thank all of those who've been involved in 10 years of Dodd-Frank implementation. In particular, the Office of the General Counsel and the Chief Economist's Office have been engaged in every single one of the rules that has been put forward over the course of the implementation period, and I want to commend them for the tremendous time and energy that they've put forward in helping us to arrive at where we are today. I want to specifically express my gratitude for the hard work and the dedication of the staff of the Division of Swap Dealer and Intermediary Oversight today, some of who spent their morning answering my last-minute questions with regard to this meeting. So they may request that we never have an afternoon meeting again, Mr. Chairman. So when we last met on this topic in December, I spoke of the importance of regulatory certainty for swap dealers, and today's action will hopefully achieve that and enable the swap dealers under CFTC capital rules to more comprehensively ascertain the cost of operating this business. While adequate regulatory capital for swap dealers is an important component of the post-crisis reforms, the development of capital rules involves difficult questions to be answered about these costs, and complicated decisions have to be made. Robust capital obligations are reasonably considered to increase the safety and soundness of the system, but we must ensure that such requirements do not deteriorate the availability of counterparties and liquidity required for well-functioning markets. The benefit of capital requirements must be balanced to prevent disproportionate, unfavorable impact on the very markets we are attempting to protect. While only time will serve as the judge of our actions today, the preamble speaks to how the Commission will continually monitor and evaluate the final rule and make fact-based assessments about the efficacy of today's action. As I have repeatedly stated, this sort of a look back is always prudent because the markets we regulate are dynamic. Therefore, the rules we and our predecessors adopt require ongoing review and possible adjustments by this Commission and our successors. We are wise to remember that flexibility that Congress provided the CFTC 10 years ago was designed to ensure that the regulations we put in place today can be properly adapted when necessary. And I appreciate very much that we are finalizing the last element of our Dodd-Frank mandate, but at the same time considering whether or not the rules that have been put in place over the past 10 years are in fact achieving their intended purpose. I anticipate that the rule we're finalizing today will be submitted to the same scrutiny in the future, and I think that is important, and I think that is wise. So with that, I will turn it back to you, Mr. Chairman. I'll reserve the balance of my discussion for the question and answer session. Thank you.
Thank you very much, Commissioner Stump. Commissioner Berkovitz.
Thank you, Mr. Chairman. I have a statement now, and then I will have a shorter statement later as we discuss the capital rule. As has been noted already, 10 years ago yesterday, President Barack Obama signed into law the Dodd-Frank Wall Street Reform and Consumer Protection Act. Drafted in the midst of the most severe financial crisis and economic recession since the 1930s, the Dodd-Frank Act created a new comprehensive framework for regulating swap markets. The absence of swap market regulation and transparency had helped cause the crisis. Over the past decade, the CFTC has worked diligently to develop regulations to implement the Dodd-Frank framework. We have made much progress. Today, our derivatives markets are stronger and more resilient as a result of the CFTC's regulations, as well as their effective implementation by many market participants. Unfortunately, our progress is now threatened. Today, the Commission is considering the first of three major rules that will address, and in one case, readdress, core Dodd-Frank Act requirements. These rules will not provide the protections Congress intended. Rather, they are designed to either confirm the status quo or cut back existing protections. There is never a good time to weaken good financial regulations. It is particularly bad timing to do it in the middle of a pandemic that poses clear and present dangers to the economy. Financial markets are currently facing their greatest challenges since the 2008 crisis. The COVID-19 pandemic has wreaked havoc on American businesses and households. Nearly 18 million Americans are unemployed. Companies in sectors as diverse as restaurants, auto rentals, clothing, dairy, and energy have filed for bankruptcy. Businesses in many other industries such as travel, transportation, and recreation are severely threatened. Over the past few months, the derivatives markets have experienced unprecedented volatility and price extremes. Although it would be premature to declare success with respect to the current crisis, so far, despite bankruptcies, volatility, and uncertainty, the derivatives markets have continued to perform their essential functions. American companies have been able to rely on and have confidence in the integrity of derivatives markets to manage the extraordinary risks arising from the pandemic. During these volatile markets, high levels of swap clearing and reporting have facilitated market confidence and price discovery. The safeguards that Congress and the CFTC have built into the markets over the past 10 years have made our markets stronger today. Banks are better capitalized due to increased capital requirements. Swap markets are more robust due to the clearing mandate, margin requirements, and other new rules for uncleared swaps. The trade execution mandate and real-time public reporting requirements have increased swap market efficiency and transparency for buy-side firms. And if you heard the presentations yesterday at the Market Risk Advisory Committee, we heard and saw real hard data that really demonstrates the benefits of clearing and the trade execution requirements and our swap execution facility structure. Regulatory swap data reporting provides critical data to regulators. Our cross-border guidance that has been in effect since 2013 has controlled risk coming into the U.S. from swap activities overseas. The three new rulemakings that will soon be voted on by the Commission will jeopardize this progress. Today, the Commission will vote on a final rule claiming to implement the Dodd-Frank Act mandate that the CFTC impose capital requirements upon swap dealers and major swap participants that are not subject to a prudential regulator. Tomorrow, the CFTC will consider a rule governing how the CFTC swap regulations apply to cross-border swap activity. And third, the CFTC staff is working to finalize a new position limits rule covering swaps for the first time, as required by Congress. In their current form, these three rulemakings suffer from a common deregulatory bias that is inconsistent with congressional directives in the Dodd-Frank Act. They reflect an overarching determination to ensure that the CFTC's rules will impose only minor, if any, costs upon the financial industry and will not require any significant changes to existing industry practices. The proposals reflect excessive deference to industry self-regulatory bodies and foreign regulators. They acquiesce to industry requests to roll back existing requirements. The final swap dealer capital rules we will consider today are not based upon the risks of uncleared swaps, as the law requires, but rather are based on existing capital requirements for futures commission merchants and banks. The Commission acknowledges that there will be little or no need for most affected swap dealers to raise new capital under this rule. The cross-border rules we will consider tomorrow will permit U.S. banks and other swap dealers to avoid the CFTC's rules by booking their swaps activities in overseas affiliates while still negotiating the swaps in the U.S. and placing all the risk at their U.S. parents. At the same time, these rules will expand the ability of foreign banks to operate inside the U.S. and post to U.S. markets while avoiding CFTC regulation of those activities. The proposed position limits rules would allow much more speculation in our commodity markets without effective limits. We have repeatedly seen how speculative activity can destabilize commodity derivative markets. The proposed rule would increase current limits, which have worked well over the decades to accommodate this type of harmful activity. The desire of the agency majority is apparent. Last week, the Financial Times, based on an interview with the chairman, characterized the Commission's upcoming agenda as, quote, several new rules that would move the CFTC back from the aggressive regulatory position staked out by the chairman's Democratic predecessors under the Obama administration. Quote, the chairman is quoted as saying, as, quote, we've pared back our extraterritorial application of our swap dealer regime. The Financial Times also quoted the chairman as stating that the financial industry has been, quote, yearning for, unquote, the regulations the agency will be considering. A global pandemic is no time to weaken our financial regulations. Rather, we must work to ensure that our financial markets remain at least as robust and resilient as they have been over the previous decade in order to successfully meet the challenges of tomorrow and the next decade. Thank you, Mr. Chairman, and I look forward to the discussion today.
Thank you very much, Commissioner Berkovitz. We'll now move to our consideration of the final capital and reporting rule for swap dealers and major swap participants. After the presentation, the floor will be open for 2 rounds of questions and remarks from each commissioner. Following the close of discussion, the Commission will vote on the recommendation. The final votes conducted in this public meeting will be recorded votes. The results of the votes approving issuance of rulemaking documents will be included with those documents in the Federal Register. To facilitate the preparation of approved documents for publication in the Federal Register, I now ask the Commission to grant unanimous consent for the staff to make the necessary technical corrections prior to submitting them to the Federal Register.
So moved.
Second. Thank you very much. Well, we'll now turn to the final rule establishing capital and financial reporting requirements for swap dealers and major swap participants. At this time, I'd like to welcome the following staff for their presentation. From the Division of Swap Dealer and Intermediary Oversight, we have Director Josh Sterling, Deputy Director Tom Smith, Associate Director Josh Beal, Special Counsel Jennifer Bauer, and Senior Financial Risk Analyst Rafael Martinez. CSIO team, the floor is yours.
Well, thank you, Mr. Chairman. This is Director Joshua Sterling. Good afternoon to you, sir, and good afternoon to all the commissioners. It was great to hear your opening remarks, and it's a pleasure, as always, to be before you, representing the world-class team we have in this division. I'm happy to kick off the staff's presentation. In the Western canon, there are names that strike the heart like lightning bolts, with the febrile weight of a summer storm. Reaching us from a distant past, their words burst into our minds as primal and true, like thunder rolling across an open plain. Chaucer, Donne, Milton, and my favorite, William Wordsworth. That unequaled romantic penned one of his greatest works, known simply as Tintern Abbey, about the profound insight on life gained by return, reflection, and renewal. Upon revisiting a favored vista above the Derwent River on the Welsh border, that poet remarked on the often slow passage of time as he began his great verse, observing that it has been 5 summers with the length of 5 long winters since he had visited there. Well, to adapt those words to our present exercise, since the passage of Dodd-Frank, it's been 10 summers, the length of 10 long winters. Suppose if you've doubled up on Wordsworth, that's really saying something. So the time to be done with the monumental work of enshrining Dodd-Frank is upon us. So today, my world-class division is presenting to you the first of 2 final rules that will mark a decisive coda to this period in our history. The time is ripe indeed to be done. We look at today's final rule, capital, not as some last requirement to be struck off, but as the keystone we must fit into our swap dealer regime as we move on with our mandate to oversee market participants. So we are not here to seek passage of this rule only to record our response to crises past. Nor do we put this rule to use simply so this agency can avoid repeating the same mistakes that defined an earlier era. Rather, this rule means to put ourselves on firmer footing for the future by providing the final backstop in our swap dealer regime. And I should add, we will cover major swap participants as well in this rule as and when we have them again. So, like that poet centuries ago, we return today for reflection and the pursuit of renewal. 10 years on from Dodd-Frank, and as commissioners have observed just now, the world is indeed facing new challenges and opportunities. So let us finish the great work born of past turmoils with a view fixed squarely on the days ahead. And let's have the tools necessary to summon the agency's great talents and have a complete integrated set of standards for overseeing swap dealers. Indeed, let's all together be the global standard setter for sound derivatives regulation. Or to put it more in the vernacular, we're about done with Dodd-Frank, so let's get cracking. You know, Wordsworth also had a canny line in that poem about seeing into the life of things, getting under the surface to understand ideas and concepts more completely. That's true here too. Creating a new capital standard is hard when working from scratch, with only the most general instruction from Congress. It certainly has taken time, which is reflected in the work of my great team over many years. And from my point of view, they've nailed it, seeing things as they are and how they should be, without binding swap dealers of different stripes into ill-suited straitjackets. They have done so by erecting a final capital standard on pillars of rigor, flexibility, and perspective. This has taken a long course of considerable deliberation, and we have, for the public's consumption, I think, some slides, and I'd ask the Secretariat to please advance to our first slide. And I'll watch the screen. Thank you, sir. So we've been on a long and winding road, and we did a quick count. If you, sir, could please advance to the next slide. And just for illustration, it has been 3,359 days since we first published a rule writing on swap dealer and MSP capital. And that was 131,000 words plus. And we go on. Point is that we have had a very exhaustive rule record. I'm sure there are bigger ones, but this is certainly weighty in its own right. Now, a word on our charge from Congress before we talk about those three pillars. In Section 4SE of the statute, the legislature told us to construct a capital regime to protect against, in essence, systemic risk. But the law does not say what systemic risk is. Certainly, volumes abound on that subject all across the spectrum. But Congress was, on the face of things, silent in our case. So here's how we view it in my division. Recognizing that the CFTC is principally a market regulator, we have sought to address 2 points. First, what knock-on effects could a swap dealer with infirm capital have on the swaps markets, which could then destabilize the broader systems of banking and finance? Second, as a corollary, what role does capital play in guarding against the risk that a swap dealer could fail to perform on its obligations to swap counterparties? Recognizing that no rule or other control can ever eliminate that possibility, lest we have a capital standard that snuffs out the creative enterprise with the genius of our markets. So with the final rule, we have built a standard based on this understanding of systemic risk and how capital can address it, namely by acting as the final backstop to every other requirement Dodd-Frank has had us impose on swap dealers. So, as noted earlier, we have built this standard on 3 pillars. First, rigor. This standard will require real money, based on our discussion and analysis of available information. We're confident the final rule will require dealers to have robust capital levels. There will be real skin in the game for the first time. Second, it is certain. We have one standard that applies different measures to achieve the goal of having a real backstop. Those measures are based on capital standards that exist under other regimes in many key respects. So, for the most part, firms should have a good understanding of what our capital standard requires, because they will be used to key elements of it. It's also measurable, which is a key part of rigor. We will have a robust reporting regime to assess capital adequacy for each dealer on a continuing basis. That second pillar, flexibility. We've enhanced the standard strength by being flexible. And with that, I'll share a little anecdote about when I was in Hong Kong on business a few years ago. I was amazed to see workers repairing a high-rise building on bamboo scaffolding. I swear, that setup swayed in the wind with every step those workers took. But the ability to transfer weight and move force to focal points is what made Bamboo ideal for that task. That's true here too. We recognize that there are many different types of dealers and that they can be slotted into different major categories: regulated banking entities, broker-dealers, and FCMs, as well as operating companies that conduct commercial businesses. As a result, we have a single standard that uses different measures to accommodate these very different types of businesses. My colleagues will walk through those with you in a few moments with a handy visual aid to boot. So just like that bamboo scaffolding I saw, we think the final rule's flexibility yields a stronger capital standard. Third pillar is perspective. Capital is important, but it serves as a backstop that comes after every other requirement. Our capital standard will play a critical role in having robust and well-funded firms dealing in our markets. But there are many predicate requirements that also help ensure dealers are acting appropriately and are able to honor their commitments. We think capital should be contextualized in light of them and the roles that we serve. And I will briefly observe, in the interest of time, that those requirements cover key points like a registration and examination, internal requirements like having a risk management program, a CCO, and a compliance operation, and external conduct requirements as well, including portfolio reconciliation, compression, business conduct standards for dealing with counterparties, and so forth. We also have an uncleared swaps margin requirement, which, given the work still ongoing, I know you commissioners are well acquainted with that. Finally, after all those things, we have capital. It will provide some measure of protection if ever the rest of the regime has somehow failed to do so. And that's the role capital at long last serves. The last point on flexibility as I wrap up my remarks is to observe that our standard is strong, but it's a first step. Another element of perspective is knowing where you are on the board. While we in this division have great confidence in our standard that we put forward for your consideration, we recognize too that the final rule is the first step in creating and maintaining a robust capital regime. And I would ask the Secretary to please advance to the next slide. So this slide demonstrates that even the Basel capital standard has undergone quite an evolution over the 32 years or so since its inception. That's likely to continue. So here, with our rule, we view ourselves as being on day one and year one, and thus recognize that our own standard will need to evolve based on data we collect. My staff is therefore committed to making sure that in the coming years and decades, we do the work necessary to make sure our capital standard remains meaningful. Before we proceed further into more technical elements of the presentation, I'd like to thank the following folks who made terrific contributions to this rule writing, not the least of which would be the staffs of every commissioner's office. We thank you for your input. But for my own division, Tom Smith, Josh Beal, Jennifer Bauer, and Rafael Martinez. From the Office of the General Counsel, Dan Davis, Carlene Kim, my law school classmate Paul Schlichting, Herminio Castro, and Mark Pfeiffer. The Chief Economist's Office, I would like to thank Lee Hong McPhail, as well as Scott Mixon, and I must say that our former Chief Economist, Bruce Tuckman, in his tenure provided terrific insight as well. I'd also like to point out that we have collaborated with the SEC as Congress had asked us to do. They are our great partners in financial markets regulation, and so I'd like to note the following folks, among others, the SEC, who are helpful in reviewing our rule that we put forward for your consideration. Mike Macchiaroli, Tom McGowan, Randall Roy, Sheila Schwartz, and Valentina Ding. Lastly, and I think most importantly, I want to thank Dan Grimm in the Chairman's office because he literally has been, quote, the man in helping get this to where we are today. So thank you, Dan, very much. At this point, I'm going to turn the presentation over to Josh Beal, the more intelligent of the two Joshes in my division, to walk you all through the more technical elements of our rule. So with that, I will tee up Josh to continue. Thank you all.
Thank you, Josh. Mr. Chairman, Commissioners, staff requests Commission approval to publish in the Federal final rule establishing the minimum capital and financial reporting, record keeping, and notification requirements for swap dealers and major swap participants, as well as amendments to the existing regulations for futures commission merchants to impose specific capital requirements for swaps and security-based swaps. The final rule before you today would implement provisions within Section 731 of the Dodd-Frank Act that direct the Commission to adopt regulations imposing capital requirements and financial condition reporting on swap dealers and major swap participants. The Dodd-Frank Act applies a bifurcated approach that requires each swap dealer and major swap participant for which there is a prudential regulator to meet the capital requirements established by the applicable prudential regulator. And each swap dealer and major swap participant for which there is no prudential regulator, including non-bank subsidiaries of bank holding companies, to meet the capital requirements adopted by the Commission. In 2011, the Commission proposed rules laying out a basic framework for swap dealers and major swap participants. In 2016, following proposals on uncleared margin and capital requirements for security-based swap dealers by the Securities Exchange Commission, or SEC, the Commission reproposed a more refined rule set that, among other things, took into account entities that may duly register with the Commission as a swap dealer and the SEC as a security-based swap dealer. And in 2019, the Commission reopened the comment period in recognition of significant market developments since the 2016 proposal, including the SEC's adoption of final margin, capital, and financial reporting requirements for security-based swap dealers. The Commission also requested specific comment on various aspects of the 2016 proposal and invited commenters to provide detailed data in support of their comments. The Commission, in total, over the course of its several releases, has received nearly 100 substantive comments and conducted over 65 ex parte meetings. The commenters have ranged from a variety of market participants, including swap dealers of all types, both commercial and financial entities, industry organizations, and regulatory oversight bodies. In addition, as required by the Act, staff has consulted on a routine basis with the prudential regulators and with the SEC on margin and capital requirements for swap dealers and security-based swap dealers. As also required by the Act, staff has directly solicited and received comment on these rules from the prudential regulators, including the Federal Reserve Board, the Federal Depository Insurance Corporation, the Office of Comptroller of the Currency, the Federal Housing Finance Agency, the Federal Farm Credit Association, and as well, of course, the SEC. Before moving on, and on behalf of everybody on the capital and margin teams here at the CFTC, I wish to not only thank those agencies for their constructive feedback in formulating these rules, but of all the commenters as well. Capital rules by their nature are often complicated and all-encompassing, and to ensure that these rules are measured and balanced takes an extraordinary amount of valued input from our colleagues, and we certainly would not be able to do that effectively without constructive engagement across the many stakeholders. So thank you. To date, there are 108 swap dealers that are provisionally registered with the Commission. Of those, 56 are subject to the capital and margin rules of the Commission, while the remaining 52 are subject to the rules of a prudential regulator. The 56 provisionally registered swap dealers for which the Commission is primarily responsible for establishing their capital requirements represent a diverse group of corporate entities. Based on our analysis, 4 of these firms are large broker-dealers that are duly registered with the SEC. 24 represent foreign domiciled entities, likely subject to existing comparable capital requirements of a foreign regulator, while several of the remaining are non-bank subsidiaries of existing bank holding companies or standalone commercial entities or subsidiaries thereof. For these reasons, today's rule is flexible in its design and permits compliance with the Commission's minimum capital requirements by leveraging off already existing capital regimes. Keeping with the proposal, swap dealer registrants are offered a choice of one of three methods to calculate their capital. The first, bank or Basel-based method, incorporates by reference certain capital adequacy rules of the Federal Reserve Board and applies such rules to the swap dealer as if the swap dealer itself was a bank holding company. The second, a net liquid assets method, incorporates by reference the SEC's rules applicable to security-based swap dealers and is based on the existing capital requirements traditionally imposed on futures commission merchants and broker-dealers. And third, a tangible net worth method designed for swap dealers that are predominantly engaged in non-financial activities. The final rules also include a capital comparability determination process, wherein foreign domiciled swap dealers can apply to the Commission to utilize a capital and financial reporting regime of a home country foreign regulator as substituted compliance for the Commission's capital and financial reporting requirements, subject to, of course, certain conditions. For those swap dealers duly registered as futures commission merchants, the rule requires these registrants to comply with existing futures commission merchant net capital rules, and several amendments to those rules have been made to more appropriately reflect swap activities. Finally, the final rules include reporting, record-keeping, and notification requirements. These requirements are comparable to already existing reporting, record-keeping, and notification requirements for futures commission merchants, and to the maximum extent practicable have been harmonized with the SEC's requirements for security-based swap dealers. As indicated in the 2019 reopening, the Commission considered making several modifications to the 2016 proposal as a result of comments received and several developments since those rules had originally been proposed. Accordingly, the Commission asked several questions regarding possible modifications to the 2016 proposal and requested further comment on data to support certain levels of capital. I would like to discuss some of the modifications which have been incorporated into the final rules based on those comments received. First, the final rule adjusts the margin amount used in calculating capital and minimums to only include margin on positions on uncleared swaps. This modification aligns the minimum calculations in each of the methods to focus on products and markets that the Commission regulates. In addition, the margin amount multiplier has been adjusted from 8% to 2%, but only for swap dealers electing the net liquid assets capital approach. And I believe we have an additional slide that shows a breakdown of this margin amount, if the operator can turn to that. In this regard, for swap dealers that are duly registered as futures commission merchants, the 2% multiplier will function as an add-on measure to already existing margin multiplier used in determining futures commission merchant capital requirements. Second, the composition of capital requirements for swap dealers electing the bank-based approach have been adjusted. These swap dealers will be required to hold regulatory capital that must meet the following requirements. First, 8% of risk-weighted assets must be held in the form of common equity Tier 1, additional Tier 1, or Tier 2 capital as those terms are defined under banking rules adopted by the Federal Reserve Board. For purposes of this component, 6.5% of risk-weighted assets must be in the form of common equity Tier 1. Second, 8% of an uncleared margin amount must be held in the form of common equity Tier 1, additional Tier 1, or Tier 2 capital. Third, a baseline floor amount must be met consisting of $20 million of common equity Tier 1 capital. And finally, as is consistent across each of the approaches, an amount determined by the Registered Futures Association. A third modification concerns the eligibility requirements of swap dealers electing the tangible net worth approach. These commercial swap dealers will be permitted to apply the predominantly engaged in non-financial activities test at the parent level, but these firms will be required to capitalize according to the rule at the registered entity level. Fourth, each of the approaches permits the use of internal models subject to approval by the Commission or the National Futures Association. Several modifications have been made to the model approval process to ensure that swap dealers will be in a position to use models at the compliance date. This would include permitting swap dealers to use, on a provisional basis, internal capital models that have been approved by the SEC, a prudential regulator, or a qualified foreign regulator for the swap dealer itself, or an affiliate in its corporate family. In addition, several modifications have been made to the financial reporting and record-keeping process. The final regulations expand the permitted use of international financial report standards to swap dealers domiciled within the United States, provided that those swap dealers do not otherwise prepare their financial statements using generally accepted accounting principles. Commercial swap dealers electing the tangible net worth approach and major swap participants will be permitted to file quarterly unaudited financial reports instead of monthly financial reports as required by other swap dealers. The time frame for swap dealers electing the tangible net worth approach and major swap participants to file their annual audited financial statements has been extended from 60 days to 90 days. Other modifications have been made to the financial reporting, record-keeping, and notification requirements to align them with the requirements imposed on security-based swap dealers by the SEC. The final rules do not include a separate liquidity requirement. Swap dealers will continue to be subject to a general liquidity requirement as part of its risk management program under Commission Regulation 23.600. The final rule also does not include a requirement for weekly margin position reporting. This provision was proposed to provide information that has subsequently been incorporated into the Commission's Part 45. Finally, staff recommends that the Commission adopt a compliance date of October 6, 2021. This will permit swap dealers and major swap participants to have over 14 months to come into compliance with these requirements. Further, this compliance date will align with the date finalized by the SEC for security-based swap dealers and major security-based swap participants. And that concludes our remarks, and we are happy to take your questions.
Well, thank you so very much, Josh and Josh. This is Chairman Tarbert. I really appreciate that insightful presentation and for the outstanding work in preparing this significant rulemaking for Commission consideration. To begin the Commission's discussion and consideration of these rulemakings, I'll now entertain a motion to adopt the final capital and reporting rule.
So moved.
Second.
Thank you. I'd now like to open the floor for commissioners to ask any questions. Again, we'll go in order of seniority. So I will go ahead and ask just a couple of questions on my end. As I said in the beginning, I obviously support this rule and want to thank you for your outstanding work on it, as well as all of our predecessors, both my predecessors as chair and the other commissioners, past and present, who have worked on this. So we've got these three different methods of capital for those swap dealers who are not also FCMs. And that's the bulk of them. I guess, could you briefly explain well, actually, let me just start with a very basic question, just because I don't want this to get lost on those who are listening to this from the general public. Maybe Josh Sterling, could you explain to us the current capital requirements in effect for swap dealers?
Yes, sir. Thank you, Mr. Chairman. This is Josh Sterling.
CFTC swap requirements. Yeah, sorry. CFTC capital requirements for swap dealers.
Yeah, yes, sir. I can report to you and to the Commission and the public that 10 years after Dodd-Frank, there is currently no such requirement.
Okay, so literally we have no CFTC requirements for swap dealers right now. So you know, they may be subject to other requirements if they're regulated by the bank regulators or the SEC, but particularly I would think those that are industrial companies, agriculture, or energy, My guess is they have no capital requirements whatsoever. Is that correct?
Correct, sir. Yes.
Okay. Okay. So it would be very difficult to describe this as deregulatory if for the first time in 10 years we're actually imposing capital requirements. Is that right?
Yes, sir. I believe it is. It is indeed pro-regulatory, if there is such a thing.
Okay. So then let's get into those regulations. We've got these three different methods, and they depend upon the kind of entity you are for the most part, though potentially you could choose. One of the things that I think strikes me is we've got a 2% level for the net liquid assets net liquid assets approach when we're talking about risk margin, but yet we have we've retained the 8% for the bank-based approach. And for the tangible net worth capital approach, that was back in the proposal from 2016. Is that correct?
Yes, that is, sir.
Okay, and then either Josh can answer this question. So could you explain why we went with the 2% for the net liquid assets approach?
Mr. Chairman, this is Tom Smith. I can jump in on this one to start off.
Thank you, Tom. Please.
No problem. There's substantial differences in the calculation that warrants a different approach, and let me explain that. So the starting point for measuring the minimum level of capital under the three approaches, the net liquid asset, the bank-based, and the tangible net worth approach, is consistent in that it's basically looking at what is the balance sheet equity of the swap dealer. And under the bank-based approach and the tangible net worth approach, there is an adjustment for intangible assets, but effectively the swap dealer that meets or elects those approaches would be able to use its full balance sheet equity in order to meet a percentage of the risk margin amounts. Under the net liquid asset approach, it's much different. That is only the starting point. Then there needs to be a series of adjustments that are made to the capital. And those adjustments include, first, excluding all illiquid assets, such as non-marketable securities or unsecured receivables. They're all deducted, as well as any fixed assets. So you're really narrowing it down to not what the equity is, but what are the absolute liquid current assets of the dealer. And then in addition to that, to protect against price changes of those liquid assets, there are market risk charges that are further applied to reduce the amount of capital that would be compared to the risk margin amounts. So it's because of this nature of how you compare. One is based on the tangible net worth and bank-based approach on your total capital effectively versus the net liquid asset approach, which is based on a substantially reduced balance sheet number that the percentages were adjusted.
Thank you very much for that clarification, Tom. And I guess one just quick follow-up question. If we had gone with something like 8%, in your view, would that have seriously sort of jeopardized the broker-dealer model and potentially given an unfair advantage to those that were using the full amount of equity capital yeah.
Yes, I think absolutely it would have incentivized entities to use the bank-based approach. Absolutely, yes.
Okay, so we want it to be fair and even-handed in doing the capital requirements, so we didn't unfairly disadvantage other business models that are out there and under our other regulators. For example, the SEC.
That's right, because some of the dealers will be duly registered entities, so they'll look at this and say the best method for them would be to have one single calculation under the net liquid asset approach. If we would have kept this at 8%, that would have been a significant issue for them. That's right.
And then that's just one. Basically, you have to take the highest of various measures under all three approaches. Going to the bank-based approach, and I have a background in this. I had studied the first Basel Accord of 1988 and done some academic work on it, and traced it ever since. the Basel, the minimum capital requirement, the Basel-based requirement that is used as our threshold amount here, that's actually not the minimum capital requirement under Basel. Am I correct? But actually, the well-capitalized amount.
That's correct. What we're proposing for the minimum requirement is that the entities following the bank-based approach would need to have 8% of capital to meet the risk-weighted assets, which is sort of the bank approach. But we're not limiting it to common equity tier 1 as we proposed. Under the current banking regime, a bank would be deemed adequately capitalized at 4.5%, 4.5%, and well capitalized at 6.5%. We're going with the well capitalized, which is higher than the current banking requirement.
Right. So we're even. Would you say that we're even taking kind of a more conservative approach than even what the banking regulators themselves do, when they're talking about adequately or minimally capitalized?
Yes.
Okay. Terrific. Josh Beal, in his presentation, mentioned earlier that we were not going to include a specific liquidity requirement, but I also don't believe Congress required us to do that. Is that correct? A quantitative liquidity requirement?
That is correct.
Yes. Okay. But yet we actually do have liquidity requirements under 23.600. Is that correct?
Yes, that's correct.
Okay, so we actually have liquidity rules currently in effect. One final question for me. Obviously, there are minimum capital requirements, but there's also the potential use of models. Could you please explain the model approval process and NFA's anticipated role?
Yes, this is Tom Smith again. So the rules would allow a swap dealer, either an FCM swap dealer or a standalone swap dealer, to use models for purposes of computing market risk and credit risk capital charges. And the rule establishes that the swap dealer may submit the model to the commission or to the NFA for review and approval. The rule also provides that the commission will conduct a determination by looking at the NFA's process to ensure that it is, with respect to the regulatory requirements, consistent with ours, and also with respect to how a model approval process would be performed, would be consistent with the CFTC sort of approach. That will provide us with a basis for accepting the NFA approval as an alternative means of compliance with the CFTC's model requirements. We will perform that assessment of the NFA's process and rules as soon as we possibly can after the effective date of the rules, and we'll work closely with NFA on that. And it's anticipated that if we find it to be consistent with the CFTC's approach, we would issue a determination in the form of a letter so that the public would be aware of that. Now, NFA will focus initially on swap dealers that do not have any other form of approval for their models. They don't have a prudential regulator or the SEC or a foreign regulator that has looked at their models. So we recognize that in the compliance period, there is only 14 months possibly for all models to be reviewed and approved. We do not want to be in a situation where entities are waiting for model approval. That would be at the compliance date, and would have to use sort of the standardized charges, which are much higher. So the way the rule is drafted currently and what we're proposing is that there would be a process whereby a swap dealer that has approval of the SEC, a prudential regulator, or a qualified foreign regulator, either itself or in its corporate family, could certify to the commission that its capital requirement meets the qualitative and quantitative requirements established in the commission's rule, and could use that model at the compliance date, pending the NFA sort of further review and approval of that, which will be done as part of the NFA examination and oversight process.
Great. Thank you so much, Tom, and thank you to all of those that worked on this. I don't have any further questions for this first round, so I will go ahead and turn it over to Commissioner Quintens.
Thank you, Mr. Chairman. This is Commissioner Quintens. Let me echo your gratitude to this team. I have particularly enjoyed and valued the number of discussions I've had with Tom Smith and Josh Beal, and more recently with Director Sterling on capital over the last not only number of months, but ever since my commissionership began. I'm just very grateful for not only engaging during those opportunities, but for this product in front of us today. And Mr. Chairman, I'd like to bring up the first issue that you raised, which is that there's been some language used already, highly unsubstantiated language that I take some issue with. As you said, and as Director Sterling said, there are currently no federal minimum capital standard or requirements in place for CFTC regulated non-FCM swap dealers. And the idea that imposing new requirements could in any way be considered deregulatory, I think, is absurd. And we can't just make things up and throw terms around to fit a predetermined narrative about what things may or may not be happening that are on complex subjects with complicated dynamics. I mean, I guess it could be considered deregulatory if we were actually just giving away money to firms. Director Sterling, is that what we're doing in this rule?
No, sir, we are not.
Okay. I didn't think so. As I read it through, I didn't think that's what we were doing. Other terms were used, like weakening protections or, quote, threatening the progress that has been made. I didn't hear any concrete examples about that. In fact, I've got plenty of examples of the exact opposite, that the standards which the prior proposals contemplated or could have allowed would have had a highly negative effect on firms' ability, financial firms' ability to serve their clients, and on end users' ability to access hedging services. This gets back to my opening comments. Capital has to be balanced because it serves two purposes. It serves to ensure the safety and soundness of the financial system and provide a high degree of confidence that there is resiliency in a crisis, while also allowing for enough economic return to those specific activities that it doesn't disincentivize financial firms from providing those services and allowing end users to access those services. I thought it was ironic that there was a discussion about all the bankruptcies that have happened during the COVID-19 pandemic, and yet it's my belief, if we're going with hypotheticals, it's my belief that if any of the capital requirements that could have been in place under the prior punitive rules were actually in place, we would have seen many more bankruptcies because of a lack of hedging services that would have been provided to those firms. So let me move on from that. If anyone has concrete proposals, we received over 200 comments in ex parte meeting on the prior during the prior three comment periods in 2011, 2016, and this most recent reopening. And they weren't all from Wall Street firms. Many of them were from end user firms, National Council on Farmer Cooperatives, Federal Home Loan Banks, Commercial Energy Working Group, American Public Gas Association, the Electric Power Supply Association, the Air Transport Association of America, the Corn Growers Association, the American Petroleum Institute. And they all had significant concerns with the prior approaches that were articulated. So let's recognize those facts before we start throwing terms around that are understood, but that can just be assumed if it fits a predetermined narrative. So to the facts, I would like to ask a little bit again about the tangible, the net liquid asset approach and the tentative net capital approach, Tom, as you were describing it. So I think it's fair to summarize that description as saying that that the net liquid asset approach and the adjusted net capital bottom line, footed equity, is a much more restrictive form of capital against which we are trying to calibrate a percentage charge of the risk margin amount.
This is Tom. Yes, that's absolutely correct.
And not only is it a more restrictive form of capital, but the market risk charges and the credit risk charges change along with market conditions to deduct from capital in a similar way that they change with those same market dynamics to increase the risk margin amount, since that's a risk margin amount on uncleared swap activity. Is that correct to some degree?
That is correct. If the margin is going up, indicating an increase in volatility on the positions, that would generally mean that there'll be an increase in the market risk charges. Again, speaking generally, yes, that's correct.
Yeah, and I mean, there can be examples where those market and credit risk charges deduct a significant, by that I mean over 50-60% of the tentative net capital. So we're in a situation where we can have, through those calculations, we can have a much more reduced amount of capital that we're looking at just through the framework that we've selected. So, to me, it makes an enormous amount of sense to adjust how we think about, comparing a risk margin amount percentage to that construct as we would to, the bank-based approach. Tom Smith, I wanted to ask you a follow-up question from something that you stated during our last consideration of this reopening. In a response to a question, you said the 2016 proposal, there was specific rule text as to what the commission was looking for with a potential capital rule, but it also requested specific comments on such things as the 8% on Common Equity Tier 1 and the risk margin amount threshold. Questions were asked: was it too high? Was it too low? Should it be adjusted? Should there be changes to the products included in those calculations? And those are the types of things that the commenters did provide feedback on during the comment process, which we are highlighting here in that reopening. Now, to say that it would be beneficial for the commission to be able to quantify some of these differences to come up with an appropriately calibrated approach to capital. So either Director Sterling or Tom, in the discussion you have had with firms in this ensuing comment period, do you feel as though you and DSIO have understood the impact of those various approaches in this reopening, such as removing cleared swaps from the risk margin amount and moving down to a 2% test in the net liquid asset approach?
Yes, Mr. Commissioner, this is Josh Sterling. Yes, the meetings with the firms and others were very useful in us coming to the reasoned approach we've put before the commission.
Okay, thank you. And let's see. Maybe I'll stop here. One final question, which is on the net liquid asset approach and the adjusted net capital calculations. Can the best person to walk me through this and walk us all through this would be great. What were the arguments for why proprietary cleared swaps were removed from the calculation of the risk margin amount? Is it not that these products are now, are we completely disregarding these products? Are they completely unaccounted for? Or is it that they're accounted for in some other calculations?
This is Tom Smith. They are accounted for. What we're talking about here with the minimum capital level is the floor, the absolute floor that an entity that's a swap dealer would have to meet. Every position that the swap dealer has, be it swaps, be it equities, be it options, treasuries, they're all subject to capital charges as well. And the way I look at it is, if we had no floor at all, that doesn't mean that or risk margin amount calculation, that does not mean that the swap dealer does not have to have capital. This is setting a minimum level of capital, which the other charges are added on top of that. So all the cleared transactions are still subject to market risk charges. based on the risk that they present under either a standardized calculation or under a model approach. But there are capital implications for all of the positions held by the swap dealer, no matter what they are.
Okay, thanks very much for that, Tom. With that, I'll close out my first round here. Thank you, Mr. Chairman.
Thank you very much, Commissioner Quintens. Commissioner Benham.
Thanks, Mr. Chairman. And I'd like first off to thank the entire team, Josh Sterling, Tom Smith, Josh Beal, Rafael Martinez, and Jennifer Bauer. Appreciate your time, your commitment, your working with my office on this very complicated role. I think Josh Beal mentioned it, but this is highly technical and complicated, and we have the right people doing it at the commission, and I appreciate your efforts and, again, your willingness to work with my team as we've gotten to today in this vote. I think if we don't mind, and this is a little bit different than what I initially thought I would ask about, but given the conversation about the three approaches, net liquid assets, tangible net worth, and the bank-based, I've asked this question of the team before, but I think it's helpful and a little bit to dovetail off what the chairman asked about. If Tom or Josh could, either Josh for that matter, could just help me understand a little bit better, and I think it's important for the public. We mentioned, at the top of the meeting how diverse our market participants are, our registrants are, obviously from financial institutions to energy companies, manufacturers, agricultural producers. It's what makes the CFTC unique, and I think that's why, Tom, if I recall conversations we've had and explanations you provided to me, that's why we provide different tools for our market participants, and in the case of capital requirements, having these three different methodologies. So if you don't mind briefly, could you just kind of characterize to the extent you can how and what you expect certain registrants will use and avail themselves of with respect to these three methodologies? Obviously, you mentioned some 50 some odd dealers that we expect to be subject to the capital requirements, but whether it's from a financial institution to a commercial energy producer or a large agricultural co-op, why is one better than the other? Why is one methodology better than the other, and how does it fit into their business model that allows them to both properly assess the assets they have, the liabilities they have, and how to appropriately calibrate the capital requirements that will impose on them?
Yes, this is Tom Smith, Commissioner. Thank you. So, as you point out, the final rule has three prongs to it, and that we talked about: the net liquid asset, the tangible net worth, and the bank-based approach. And one of the reasons for that is the statute itself provides that the CFTC, the prudential regulators, and the SEC shall, to the maximum extent practicable, establish and maintain comparable minimum capital requirements. So when we looked at the entities that registered with the Commission, and this goes back to 2011, we recognized that we didn't really have, we had a diverse group, as you appropriately pointed out, and we looked at that. And so what we decided to do, consistent with the congressional mandate, is to provide the swap dealers with a choice of electing the bank-based approach, which we would expect that we have many swap dealers that are non-bank subsidiaries of bank holding companies. They currently maintain their records in accordance with, from a capital perspective, with bank holding company capital requirements. They get consolidated into that parent entity as part of their consolidation. So this would allow them to maintain a set of records and a process that we understand that they currently are subject to indirectly and follow. With respect to certain other entities, we recognize that they were going to be dual registrants, and the SEC, in their final rules, and which is consistent with what they proposed, they kept the traditional broker-dealer FCM approach, which is different from the bank-based approach in certain respects. And we're very comfortable with the CFTC FCM capital approach, obviously. We have no issues with a swap dealer electing that approach, so we made that as an option as well. And it would also greatly benefit the dual registrants, as it does FCM broker-dealers today, and that they would keep one set of books and records, had very similar calculations of what their capital is. We have what we call a harmonized and uniform capital rule with the SEC with respect to FCM broker-dealer requirements. In fact, our regulations provide that to the extent that a FCM has an asset or liability on its financial statements that are the capital treatment is dictated by SEC rules, that the FCM should follow those rules unless the commission's rules dictate otherwise or state otherwise. So we've had this harmonized approach for many years. It's been very successful. It's not only in capital, but it's also in financial reporting, where we accept focus reports in lieu of financial reports that are required under our rule, what's referred to as the Form 1FR FCM. So they're very similar that way. Then we also had commercial entities that registered as swap dealers, and they raised different issues because the bank-based approach and the net liquid asset approach are really designed for financial institutions, as I mentioned, and the best example is the net liquid asset approach, which does not allow an entity to recognize property, plant, and equipment type of assets. That might be very difficult or challenging for a commercial enterprise. And the approach we took there was to recognize that commercial entities have a different balance sheet structure, have assets that would not necessarily fit into the other two regimes, and proposed and now recommending to go final with the tangible net worth approach, which would allow it to look at its balance sheet and then add to that equity any market risk and credit risk charges that are associated with the swaps transaction. So we are picking up the swaps and security-based swaps through the market risk and credit risk.
Next question, which is a bit related, but and I know the chairman touched up on this on the 2% multiplier. Obviously, we've discussed, and it's been shared, that the 2016 proposal had 8%. Is there anything, and the chairman asked about why and how we landed at 2%. I guess if I could adjust that question a little bit, same theme is, has anything changed, I think, from 2016 and what you were thinking and what the then commission was thinking of landing at 8%? And what I mean by change, specifically from a market perspective, that would have required or demanded, or I think from a data perspective, brought us to 8%. And then was there any contemplation of landing somewhere in between 8 and 2? Obviously, any number of variables could be there between those two numbers, but I think, from a percentage standpoint, it seems from its face a pretty steep change from 8 to 2. Yeah. So I'm wondering, what from a commission standpoint and from a staff standpoint got us to this point where we moved from 8 to 2, and is there anything from a market perspective, evolution or otherwise, since I would assume 14 or 15 that things have changed that you wanted to land at 2%?
Mr. Commissioner, this is Josh Sterling. I'll begin to answer that question, and then, as you know, Tom and Josh are our technical experts who can elaborate. But, sir, I think the answer simply stated is I wouldn't say there has been a market evolution. I believe that what we really did is we got into the detail of how a net liquid assets approach is calculated and the difference between, where the risk margin amount would hit in terms of the assets and scope. And I think the difference in percentages we're talking about, which, by the way, I'll support what we think is a very strong overall standard, sir, is sort of driven by where that percentage hits in the calculation compared to, say, the bank-based approach. And I would please ask Tom and Josh, as they usually do, to flush that out.
So this is Tom Smith. So yes, we looked at this and we tried to determine. I agree, there isn't really any market change in this, but we thought that based on the analysis that we could do, which was not much with data, like establishing the percentage at a level that would allow the market participants, allow entities to elect this approach to operate while we continue to sort of look at what the minimum requirements are based on the data that we actually do receive in the future. So it's, when we were adopting this or looking at this the first time, one of the thoughts was that we would ask for data as part of the 2016 proposal, and then we ask questions again in 2019 to hopefully get a more precise measure of what the how to calibrate this. And this really is a question of calibration, which I think we'll always continue to look at and need to adjust as we go forward.
Thanks, Tom. I don't know if someone wanted to jump in or not, but my final question within the context of this issue is, I think if I recall reading the comments, there were a number of commenters from the, I assume, I guess the 2016 proposal and the ones that sort of influenced and drove the 19 proposal and now what we're voting on now. But there were a number of commenters who, outrightly said 8% was too high. Is that correct?
Yes, that's correct.
Okay. And the 2%, and I appreciate that answer, was there any element, especially obviously, to clarify for the public too, this is applying to the FCM swap dealer specifically, was 2% driven in any part by our efforts, and I appreciate all the work that's done to harmonize with the SEC, but any effort to harmonize with the SEC's approach, was 2% driven by that at all, or just the unique circumstances and reasons that you provided thus far?
This is Tom Smith again. Yeah, no, part of the analysis was that if we were to have a 2% approach, it would harmonize with the SEC's approach, which is consistent with the Section 4 SE of the statute, and that was certainly part of it. And another aspect to this, maybe going back to one of your previous questions, for the 2%, we're still looking at these. This is for uncleared swaps transactions. Like for an FCM swap deal, we have not adjusted the 8%
right.
of the margin amount required on customer and non-customer futures, foreign futures, and cleared swaps transactions. And we have the 2% for the, so that's where we do differ with the SEC in the sense that if a security-based swap dealer has customer cleared security-based swaps, their minimum capital requirement is based on 2% of that, like it is for the uncleared security-based swaps. We did not want to adjust what we think is an appropriate FCM capital requirement by reducing or changing that number at this point in time. So we kept that at 8%, and we have the uncleared swaps at 2%. And just as a side comment, generally speaking, the margin required for the uncleared transactions are higher than the cleared transactions. Under our rules, generally speaking, again, on a cleared future or cleared swap transaction, the holding period or the confidence level that needs to be set is that it's sufficient level of margin to cover a one-day market move, and on the uncleared swaps, it's to cover a 10-day margin period of risk. So it's generally a higher number to start with.
Thanks, Tom. I want to turn, while I still have some time, to the review period. And for those of you who are listening and may not know, but the language in the rule essentially, and correct me if I'm wrong, team, but something along the lines of that within 5 years of the effective date of this final rule, if it's passed by the commission, the division will essentially assess and review the 2% risk margin amount. So I think this is probably for the director. Any plans, expectations, or thoughts on how the commission or the division would conduct its review itself? Would it be fluid in the sense of, in essence, you'd be starting the day after, again, if this is passed, the day after the capital compliance date passes and, reviewing data and whatnot? Or is this going to be a hard, okay, we will wait till 5 years after implementation and then take a fresh look at the 2% and reevaluate? And I do appreciate what's been said multiple times at this point, that this is in fact a part of our rules and a part of our regulation that requires sort of dynamic oversight and surveillance, for lack of a better word, but constant sort of tweaking and working within the bounds of the market, which is constantly changing. So, Director, to the extent that you've thought about this or that in the language itself, can we take from this that there's a commitment from the division that this review will happen, and what's your vision for how it will happen in the future?
Yes, thank you, Mr. Commissioner, for that question. This is something that we've given a good deal of thought to because, as was observed earlier, we're going to be, as and when the rule passes, at day one, year one, on having a standard for which we're responsible, and that's a tremendous responsibility, and it certainly affects these truly large markets we oversee. And my division is one of oversight, sir, and I believe that our focus has been to take in data and analyze it. I can't predict you precisely when that would begin under this standard, but my view is that it would be ongoing. Here in 5 years, I would say, or at least be able to explain, our sense of how well things are working and make recommendations. So I sort of think that there would probably be a natural culmination based on continued oversight of swap dealers. And I will say that has been a core commitment in my time in DSIO is to make sure we have appropriate oversight as we move on from rule writing with exercises like our swap dealer heat map and other things to make sure that these firms are indeed following our rules. And so I think that assessing capital on a go-forward basis is a part of a routine oversight program. It makes perfect sense. So I hope that that's illuminating, sir.
Thanks, Josh. I appreciate that. And finally, I'll wrap up with the compliance thing. Yeah. Go ahead, Tom.
This is Tom. Just echoing what Josh said. I mean, once we start receiving financial reporting from the swap dealers, that will be very helpful to us in assessing the impact of these rules and looking at such issues, not only about the 2%, but liquidity and other issues in the firms. And the rules do require monthly or quarterly reporting depending on the type of entity you are. So we should be receiving those relatively soon after the compliance date.
Thanks, Tom. And thanks again to all the team. I'll wrap up here for this first round. Appreciate your responses. Mr. Chairman, I'll hand it back to you. Thanks.
Thank you very much, Commissioner Benham. Commissioner Stump.
Thank you, Mr. Chairman. I'd like to start by framing today's conversation appropriately and reminding folks that we are setting policy for a subset of registered swap dealers, 55 dealers that are not already subject to capital oversight by banking regulators. And the suggestion that we are today weakening capital standards cannot logically be reconciled. The banking regulators who are responsible for establishing capital requirements for the largest financial institutions under Basel standards are constantly updating those regulations. Additionally, the SEC recently extended and enhanced their capital requirements to security-based swap dealers. And today, we are simply applying our own capital requirements to 55 swap dealers. And I would also note that of those 55, 40% of them are non-U.S. financial entities. So I wanted to point that out because I think sometimes there is a confusion based upon who's responsible for what with regard to applying stringent capital requirements. Many regulators were tasked with applying capital requirements to swap dealers in Dodd-Frank, and we have a very important role to play, but we do so for a subset of swap dealers, and I want to make sure that that's made clear before we move on. Additionally, I wanted to say that Chairman Tarbert and Commissioner Benham have already pointed out that we have a lot of different types of swap dealers registered with the Commission, and not all of them are alike, and a lot of different types of swap dealers that we're required, even within the 55, to apply our capital requirements to. So it's appropriate that we have these various options. I was going to ask a number of questions specifically with regard to the options we're allowing for commodity-focused dealers, but I think the team adequately covered that in response to Commissioner Benham's questions. And so rather than repeat what's already been discussed, I've decided that I'm going to focus on two specific topics that are important as we look to the next steps after we are hopefully able to pass this rule and have it being implemented. I have two issues that I want to have the team discuss a little bit more. And first, I want to focus on the model approvals that are to be conducted by the National Futures Association. While the final rule makes considerable improvements to better prioritize the approval process for covered swap dealers' internal models, there is a new related element that warrants mention today. The rule establishes a commission review process to ascertain the consistency of NFA's approval process with that of the CFTC's approval. The Commission and the NFA are in constant communication to ensure that our objectives are aligned, and that's been the case for years. And so I hope that we will be able to leverage that interaction in order for this process review to be done expeditiously. Then the NFA personnel can focus on the task at hand, which is reviewing models on an implementation timeline that, though improved, remains ambitious. So in terms of the model approvals, the proposal requires the CFTC and NFA to review models before they could be eligible. The 2019 reopening of the comment period asked about modifying the Commission's proposal for the use of models, including how the approval process should be modified, whether there should be automatic approval of models previously approved by another regulator. The final rule recognizes the approval of other regulators under certain criteria and allows swap dealers to use those models. I'm hoping the staff can discuss the process a bit more and the expectations for applying such approvals previously approved by other regulators under the final rule. So I think Mr. Beal previously discussed this a bit, but I would like for you to drill down just a bit more on how a swap dealer may be able to avail themselves of applying and relying upon a model that has been previously approved by another regulator.
Sure. So as you rightfully pointed out, there is what I will call a provisional process where a swap dealer who has an existing model approval in the corporate family or itself effectively applies an application to us and is notifying both the NFA and us that they will be availing themselves of that requirement. The reason that is in these rules is to ensure that they can have a model that has already been reviewed and looked at by a prudential regulator, or the SEC, and they can use that model on the compliance date. That will allow the NFA to focus their attention, if you will, on reviewing in the 14 months the remaining swap dealers, of which I think there's somewhere between 12 and 14, which could possibly seek internal model approval with the NFA. The process that we have for that, and which is outlined in the rules as well, is that we will issue, through delegated authority to the director, that there will be a process of reviewing the steps and procedures that NFA will undertake, and in doing that model review process, and we will issue a letter, if you will, under the delegated authority that says that is comparable. It's almost like a substitute compliance regime as to what we would do if we were to undertake that process ourselves. So that process will undergo, almost immediately. We will begin having more fruitful discussions with NFA regarding that, and then they will then have the ability to, under the rules, approve these internal models for those that do not have any reliance from another regulator, either in the corporate family or themselves. So hopefully that answers your question.
No, it does. So essentially, we're enabling NFA to prioritize the review of models by those who, frankly, have not been approved by another regulator and don't really have the ability because they're either not regulated by another regulator or haven't been approved by another regulator. So we need NFA to focus first and foremost on those model approvals in order to ensure that the internal models can be relied upon prior to the effective date. And those who have internal models approved by other regulators will be able to certify that they do have those and that they're up to date, and then the NFA, through the course of their regular examination process, will take the opportunity to look at those to ensure that they are meeting the specific needs and requirements of the CFTC rule and an ongoing basis, even perhaps past the implementation deadline or the effective date. Is that correct?
Yes, that is correct. The certification process for those that are relying on an existing model in some way does not take away from the fact that they do not have official CFTC or NFA approval of those models. That will occur at a later date.
Right.
It's just to get them over the hurdle, if you will, of the compliance date, which is only 14 months. And what I'll say is, just briefly, the model approval process is often a very comprehensive evaluation. These models are very complicated. There's lots of elements to them, including assessments of risk management at the firm and vice versa. So achieving model approval in general is a very cumbersome and lengthy process, and that's why, as staff, we think that it is necessary to do this approach.
Great, thank you. I just want to touch on one additional, what I call next step, looking forward matter as it relates to implementation. So I had previously spoken of my hope that when we reopened the comment period last December, it would provide insight into properly determining a compliance date with the incorporation of substituted compliance considerations. And you all talked about this briefly, that the October 2021 deadline for the CFTC capital rule before us today, I think is reasonable, and it harmonizes with the SEC's implementation. I want to emphasize, though, the importance of attention to the substituted compliance determination, as that date is already fast approaching. So achieving substituted compliance for those operations in a jurisdiction that's deemed to have comparable capital adequacy and financial resource requirements should be achieved well in advance of the compliance date. And in fact, the preamble does note that applications for what we call capital comparability determinations will be addressed in an expeditious manner to account for this. So the CFTC staff, this is just a comment more than a question. The CFTC staff has worked tirelessly on our own capital rules during the past decade, and I now know that they will be able to turn their energy towards reviewing and recommending to the Commission the appropriateness of granting such comparability determinations. So I feel as though your work is never done. I congratulate you on getting us to this point, but there are certainly a number of next steps that I hope can be done in relatively short order, such that they do not bump up against the compliance date in a way that is unworkable. So with that, I'll turn it back to you, Mr. Chairman. I feel as though many of my questions have already been addressed, so I will allow the meeting to go on without belaboring many of the points that have already been made. Thank you.
Thank you very much, Commissioner Stump. Commissioner Berkowitz.
Thank you, Mr. Chairman, and I also would like to thank the staff for all their work on this rule. Although I've had a number of concerns with it, I nonetheless appreciate the consideration and the work that the staff has done and the considerations you've afforded me and my office in working on this rule. So I just have a few questions on this. Regarding the bank-based approach, do you expect that it will be used by most of the swap dealers that are affiliates of banks?
This is Tom Smith, Mr. Commissioner. From the discussions we've had with certain entities, they're very, that is a correct statement. I expect that entities that are the non-banking subsidiaries of bank holding companies, that they will look to this approach, yes.
And there's a part of the cost benefits considerations that accompanies this final rule. There's a very helpful appendix there that estimates the costs of these, or how much additional capital might be required, and other costs associated with this final rule. So from the appendix, when it's discussing the bank-based approach, it states, quote, the additional Tier 1 capital, CET1, Tier 1 capital required from the Commission's capital requirement may not be significant, as it may be possible for the consolidated entity to keep the same level of capital within the BHC, Bank Holding Company, but just reallocate it among its subsidiaries. So could you just, is that accurate that the entities that are using this approach probably can satisfy these standards simply by reallocating among existing subsidiaries, and therefore would impose no significant new capital requirements on them?
Mr. Commissioner, this is Josh Sterling speaking. I think that what I would say is there are existing capital requirements, and it's possible that, yes, indeed, as the cost-benefit analysis indicates, our requirement could be met based on the existing capital within a banking organization, which I would anticipate, I don't know this, is typically well in excess of minimum capital standards in order to be, for example, let's say, well capitalized. So we think that is possible. As we've talked about, and we've been candid in discussions with you and certainly here before the public, our focus has been on getting a standard in place and analyzing the data that's to come. But to your initial point, sir, that is correct.
Okay, and under the other approaches, is that would we expect similar results under the other two capital approach, the net liquid assets approach for those entities that would be using that approach, that there'd be no significant additional costs due to this?
Sir, again, it's Josh Sterling. I'll let Tom or Josh respond to that. I wanted to mention, because you mentioned the other tests, I would just say, to clarify for the record, sir, that for tangible net worth, that would be new for a company, say an agricultural or energy concern that does not have a regulatory capital requirement. So that would be altogether new. So in terms of an actual capital requirement, it would be new to them. But I will turn to Josh or Tom. Yeah.
No, I appreciate. Before Josh or Tom responds, I appreciate that clarification. The capital requirement would be new. Yes, that is correct, and I'm sorry if I didn't get that correct. But then the question is, would this impose like any new costs in terms of money necessary to meet that capital requirement? So for the net liquid assets, would they have? What's your Commission's expectations regarding the need to raise additional capital under that entity that would be subject to the net liquid assets approach? Would they have to raise new capital, or would they pretty much be able to satisfy it currently?
So maybe I'll just take a stop. This is Josh Beal. I think it's fair to assume that any one of the swap dealers right now, as they currently look, have no capital requirements or very little capital requirements, and that any additional imposition of capital requirements by this rule will definitely result in increased costs in obtaining that capital. Whether or not it is existing capital at the parent level down to the subsidiary level, which is registered with us, that is still a cost allocation which that business has to account for and will take into compliance with that, including all of the financial reporting requirements, all of that. So I don't think that it's fair to assume that if they are just allocating capital across the organization, that there's no costs involved at all. I think there would be costs involved for sure.
Sort of trying to estimate additional costs, and to the extent that we have a requirement that now is requiring these entities to be capitalized themselves, if the entity is part of a larger group that has plenty of capital, I think that the argument was that it's not going to be such an additional cost because they have a lot of capital already. But but it's still the case that the entity itself may not have capital in it today. And most of these large bank holding companies are very well capitalized. The case with the net liquidating assets firm, there are several of the AN firms that have a lot of excess net capital. So even though our requirement will be additive to make their minimum higher with the addition of uncleared swap margin percentage, they still may have well more than that in the entity. So to the extent that there's a cost involved, it may not actually require them to raise more capital, but it will also reduce their excess that is reported.
I would just add to clarify the record that was my team member, Jennifer Bauer. Let's all please make sure we introduce ourselves. Thank you. Sorry.
Yeah, no, thank you. I was just confirming what is in the document, and I appreciate the differences. I appreciate the differences and the consequences. And the articulation of the consequences, and that's what we should be doing. We're promulgating a new requirement. It's going to make some changes. One of those changes may be there's going to be compliance costs with this, and there's going to be potentially for the banks that conduct dealing entities, conduct swap dealing out of entities that are currently not subject to capital requirements. There may have to be a reallocation within that entity. But I just want clarification that the whole bank is not going to require that larger entity to have additional capital overall because of this. So it's not. There might be costs, internal costs, and reallocations, and that particular entity, which might not have capital allocated to it right now, will have capital allocated to it. But overall, that bank won't have to raise more capital. I think that's what the cost benefit says here. If that's not correct, then I still want to be precisely correct. Similarly, go ahead. Sorry.
Oh, no, I was just going to thank you for that observation, Mr. Commissioner. Understood.
And then I would also observe that the document states, with respect to SDs, swap dealers that are FCMs, and ANC firms, which we really haven't discussed, so maybe you might want to briefly explain for the our listening audience what an ANC firm is. But SDs that are FCMs and ANC firms with the SEC, which there may not be any of those, so maybe we don't need to discuss those. But for the swap dealers that are FCMs, I think there's 4 of those that there's analytical, certain data that was available and analyses were available at that time when we put in the FCM capital rules, and that we don't really have a comparable or a base like that now. So we're going to be receiving data under this rule and potentially make modifications on that, which I think is the correct approach, that we take appropriate modifications as we get the data. But looking back, we're here 10 years later. I'm just puzzled why we don't have any of this data. I mean, what have we spent? I know that there's been proposals and re-proposals, but I'm sort of puzzled by the fact that we're sitting here 10 years later doing a rule where we're looking towards historical approaches and analogous approaches of SEC and the banks, and don't really have our own data on our own entities to finally craft this rule. So could you sort of talk about why we don't have this data, and then what we're going to be getting to hopefully be able to calibrate these things appropriately as we or review the calibration, however you want to term it, as we go forward?
Yes, sir. This is Director Sterling again. Thank you for that observation. I would say this, as you know, I've only been here just about a year now, and so I can understand all the work that's been done in years prior to my arrival, the arrival of the chairman, rest of the executive team, on very many different rules. And I think it's fair to say here that an important part of this rule is, of course, the financial reporting about the capital standard. And we do not have that yet. We have other kinds of reporting for sure, swap data reporting, real-time reporting, other measures of the swap market. But one of the things that we have been focused on in our time here at the Commission, particularly as regards dealers and other registered firms, registrants, is the ability to sort of use the data we have to make better informed choices. And here, looking specifically at the firms, there was a paucity of data because the rules hadn't been enacted yet. And so this is, to me, a proposition. I don't mean for it to sound simplistic, but you got to start somewhere and you got to start sometime, and that's today. And so I showed up and said, what do we got? And the answer is we got to get a rule to get the data. So that's what we're proposing to do here. Tom, Josh, or anyone else from the team, if there are any historical tidbits you would like to share, please do.
This is Tom Smith. Yes, Commissioner, there was an ability when we changed the FCM capital rule that the Commission had a very good information as to what the impact would be. And that was because we had existing financial reporting requirements on FCMs that showed us what their balance sheets actually were, how much customer funds they held, which was the measurement at that point in time as to how much minimum capital you needed to have was a percentage of the customer funds you held. But what we also had at that time is, since these FCMs were the capital rules based on customer cleared transactions, we also had information as to what the margin amount from the clearing organizations was on those cleared transactions. And for a process, I think of about 2 years or so, there was a parallel calculation being done. The self-regulatory organizations adopted a capital requirement based on the risk margin amount, if you will. And we also still had the continued CFTC requirement of having the capital requirement based on customer funds. So we were able to see very clearly the impact of the change and was able to do a very different type of cost-benefit analysis that we can do now. Where we are today is without financial reporting, we don't really know what the balance sheets look like of these organizations. If we went with financial reporting first without a capital requirement, I'm not sure that it would tell us what the actual financial condition of these firms would look like with a capital rule in place. Because if you're not subject to a capital requirement, even if you gave financial statements to the Commission, it would not reflect the actual financial position of the firm. So we were missing information about the firm, its financial condition, and we didn't also have the way the rule is sort of drafted based on the margin required for uncleared swaps on a counterparty by counterparty basis, including legacy transactions and other transactions that are exempt from the margin rules. So that's really where we were struggling with the current approach.
Thank you. That's a very helpful understanding of how we got here today, and what we can hope will provide additional information and a gauge to judge what the effect of the rule is and its adequacy going forward. So thank you. I appreciate that response. Thanks, Tom. My time is up. I'm fine, thanks.
Okay, then thank you so much, Commissioner Berkovitz. This is Chairman Tarbert. We'll go on and we'll proceed to round two. I think most of my questions, quite frankly, were answered in round one, but I think there was a lot of discussion among the commissioners about kind of the three approaches and why why they make sense and questions about them. What I think it would be helpful, I have always found helpful, is to sort of boil down something that every one of us agrees is pretty complex into a personal finance analogy, which hopefully for the public who's listening can make these concepts that we're discussing today a little bit more relatable. First, we have the concept of the net liquid assets approach. And the way I would analogize this is it's sort of like the cash in one's wallet, money that is readily available and can be spent to pay bills, buy lunch, or pay off a loan. Now, these three different approaches have to do with ultimately the ends and what they're getting at. So this type of liquid capital is important for swap dealers that have responsibility for customer funds, such as those that are duly registered with the SEC as broker-dealers. For these swap dealers, capital requirements advance customer protection by ensuring there's a readily available cushion to pay back customers in a liquidation. So that's sort of the SEC's paradigm through which they set capital requirements, and so they're looking at a much smaller amount of capital because, again, they're looking at cash in your wallet, basically. The bank-based approach, which I have a deeper familiarity with, is very different. Banks are obviously the backbone of our financial system and are subject to a specific statutory regime managed by the Federal Reserve and other federal banking regulators. By playing such a critical role in our financial system, banks, and by extension their swap dealer subsidiaries, naturally raise greater systemic risk concerns than other types of swap dealers. For a bank, the goal of capital is facilitating safety and soundness, ensuring that banks act prudently in light of their central role in promoting financial stability. So let's go back to our personal finance analogy. When you think about a bank, the concept of capital is not just cash and wallets, but also savings accounts, checking accounts, and retirement funds, as well as other financial assets. The tangible net worth approach is even broader in many ways. So these are for the swap dealers that aren't financial entities at all, but are commercial businesses in agriculture and the energy sectors. These swap dealers help American families put food on the table and gas in the car. And unlike financial entities, they compute their balance sheet assets, and they often contain, and I think Tom mentioned this, significant physical assets, such as oil refineries or bushels of grain or warehouses of agricultural commodities. And these are the ones that will likely elect the tangible net worth approach. So if we extend the analogy from personal finance here, I see capital for these swap dealers as inclusive of not just cash or retirement account holdings, but also one's house and car, the assets that could be pledged as collateral in borrowing. And so, hopefully that is helpful for some out there that are kind of trying to get their arms around these three basic types of capital requirements. They really are tailored to different institutions, and of course they're linked to the SEC's concept of capital, which is very specific in dealing with the ability to cover customer assets, customer losses, versus the bank capital access, which is about safety and soundness. And then when we look at capital in terms of an industrial company, it takes into account the net worth of all of those much harder non-financial assets like property, plant, and equipment. So that's all I really wanted to sort of put out there. And I guess I would just give it to the DSIO team for reaction, whether you think my analogy is potentially instructive.
Yes, Mr. Chairman, this is Josh Sterling. I think you've hit the nail on the head, sir. We think that's a great and compelling analogy.
Okay, terrific. Well, again, thank you for all of your outstanding work. Happy to now turn to Commissioner Quintens.
Thank you, Mr. Chairman. This is Commissioner Quintens. I've really felt like the prior discussions were very illuminating. I'd like to pinpoint on a couple things. I think first was the discussion on what contributed to the initial selection of the 8% number for the risk margin amount being applied across all different approaches, including the net liquid assets approach. And I guess this question is for the excess capital of a firm is reduced by a certain percentage over a certain amount of time. That has to be noticed to the agency or to the regulatory community. If that's not correct, please let me know. But my understanding that it is, and therefore there's every incentive for an institution to not want to have to notice that, and given the volatility that we've gone through in the last few months, that volatility could have been significant and posed, some challenges around those, getting close to those thresholds. So I would expect firms to want to carry a substantial amount of excess capital, so they wouldn't have to notice that that has been reduced by a certain percentage. So, all those things together, I think, speak to, how much capital firms are actually carrying well in excess of what any of these minimum capital requirements will be or historically have been. Let me ask one final question, and I'm going to read a little bit more of my statement, if I could. First of all, one of my questions was around the substitute compliance framework and the deadline of October that Commissioner Stump described so well, and I'd like to echo all of her comments and associate myself with her remarks there. But with regard to my specific question, this final rule allows firms electing the bank-based approach to use common equity Tier 1, additional Tier 1 and Tier 2 capital to meet its minimum capital requirements under both the 8% of risk-weighted assets and the 8% of uncleared swap margin alternative. But as a result of this increased flexibility, the final rule requires firms electing that bank-based approach to meet all of the minimum capital requirements. Will DSIO monitor the impact of this requirement to make sure it does not create any competitive disparities across the different capital approaches?
This is Josh Sterling. Yes, Mr. Commissioner, thank you for that question. We will indeed be monitoring that as well as the rest of the rule, sir. So yes.
Okay, thank you for that. So let me just close by saying that I believe the final capital regulations for swap dealers and FCMs adopted today establish minimum capital requirements that will ensure the safety and soundness of these firms for years to come, through periods of economic growth and stability and through periods of market contraction and extreme volatility. They are appropriately calibrated at this point, with our knowledge, to the true risk posed by a swap dealer or an FCM's businesses, and ensure these firms have the capital necessary to support their active participation in the markets and, importantly, in servicing their clients. And they are also largely harmonized with the capital approaches of the prudential regulators and the SEC, which would reduce unnecessary burdens and facilitate compliance. But yet no rule is perfect, and I expect there will be aspects of this rule that need to be revised or recalibrated in the future. I would specifically like to discuss a few areas that I would like to see revisited. Nevertheless, it's a common saying that you cannot build a great house without a solid foundation, and I'm confident that today's capital regulations provide that foundation and will support vibrant, healthy derivatives markets with future commissions able to build upon this progress in the years to come. So as I noted, the three areas I'd like to quickly highlight that are not addressed in this final rule, and I hope the Commission will address in the future. The first revolves around the standardized market risk charges for capital. This final rule does not adjust any of the standardized market risk charges under Regulation 1.17. I believe that many of these standardized charges are too high, given the liquidity and the actual risks of some of those products. For example, the final rule continues to apply a 20% notional standardized market risk charge on uncleared foreign exchange non-deliverable forwards. In contrast, the Commission's uncleared margin rules apply a 6% notional charge on these products for purposes of the standardized initial margin calculation. I'm hopeful that in the future the Commission can work with the SEC to recalibrate and update these charges to better reflect the risks of the underlying products. Second, I hope that with the benefit of experience and information received from financial reporting, the Commission will consider modifying its rules to recognize alternative forms of collateral, such as letters of credit or liens, provided by commercial end users that are exempt from clearing and margin requirements when computing credit risk charges. Alternative collateral arrangements are frequently used by swap dealers in commodity derivative transactions with end users to create right-way risk that can be effective means of managing the credit risk of certain derivatives transactions. I think it would be beneficial for the Commission's capital regime to recognize, as appropriate, the risk-reducing nature of those transactions. And lastly, I'm also interested in continuing to explore the commenter suggestions that firms electing the net liquid asset approach be required to maintain a tentative net capital in excess of the risk margin amount percentage, as opposed to the current net capital requirement. I continue to have concerns, as described, that in periods of high volatility, the procyclicality of increasing margin requirements against increasing credit charges may cause unnecessary stress on these firms, as their capital charges for positions increase at the same time as their minimum capital requirement. I'm interested in looking at possible adjustments that could be made to address this issue. In closing, I believe the capital regime adopted today strikes a necessary balance between capital levels that protect firms from losses and levels that allow firms to earn an economic benefit from serving their customers' risk management needs through those products. Thank you very much, Mr. Chairman, and thank DSIO and this team particularly for their hard work.
Thank you very much, Commissioner Quintens. Commissioner Benham.
Thanks, Mr. Chairman. And I will make one brief comment, and then I will go straight to closing remarks that I've prepared. But again, thanks to the team for their work, and thanks for answering my questions in the first round. I do want to address something, or at least respond in part, Mr. Chairman, to something you said about this not being deregulatory in nature, because there's an absence of anything, a capital regime on swap dealers right now, and that is in fact true. But I think in my view, that's a little bit of a mischaracterization, because I think with that logic, if we as a commissioner, any commission for that matter, put anything forward in the absence of a rule, it could be deemed regulatory. And I think within the context of the capital rule, which, as we pointed out several times already this afternoon, this rule has been proposed and reproposed a number of times dating back to 2011, and as we're here now in 2020 on the 10th anniversary of Dodd-Frank, if you look at the scope and the sort of evolution of the versions and the drafts, one could characterize it as potentially deregulatory. So just be mindful of that from my point of view, and I hope that as we go forward, we continue to evaluate, and as the team has said, and I appreciate that we're going to constantly be evaluating this rule and ensuring that we keep our swap dealers, those that are subject to capital requirements, resilient and safe, so that we do our share as the CFTC to promote safety and soundness and a resilient financial market system. With that said, I will respectfully dissent from CFTC rulemaking today regarding capital requirements of swap dealers and major swap participants. Section 731 of the Dodd-Frank Act requires the CFTC to establish capital rules for all registered swap dealers and major swap participants that are not banks, as well as associated financial record keeping and reporting requirements. There can be no doubt that Congress intended to impose significant new requirements that would contribute to the protection from another financial crisis. In 2016, the Commission issued a bipartisan proposal to implement capital requirements as directed by Congress through Section 731 of the Dodd-Frank Act. The Commission now jumps from a proposal issued in 2016 to a significantly different final rule nearly 4 years later, without any intervening reproposal to provide interested market participants clear proposed capital requirements to meaningfully comment upon. In so doing, the Commission undermines the spirit of the Dodd-Frank Act and violates the letter of the Administrative Procedure Act. The preamble to the final capital rule asserts that all of the actions taken today are, quote, a logical outgrowth from the 2016 proposal. The preamble even goes a step further, arguing that modifications described in the 2019 capital reopening, including a discussion and specific inclusion of potential rule language, were logical outgrowths of the 2016 proposal. This simply cannot be true if the requirement that a final rule is a logical outgrowth of an agency's proposed rule is to have any meaning at all. The changes in the final capital rule to the amount of capital that a futures commission merchant swap dealer must maintain are illustrative of this point. The 2016 proposal would have required an FCM swap dealer to maintain regulatory capital equal to or greater than 8% of the initial margin associated with the FCM swap dealer's proprietary cleared and uncleared futures, foreign futures, swap, and security-based swap positions. In 2019, the Commission reopened the comment period on the 2016 proposal. In the Federal Register release announcing the 2019 reopening, the Commission sought additional public input based on an initial review of comments received from the 2016 proposal on myriad alternatives, seeking comment, quote, on all aspects of the proposed risk margin amount including comments regarding the possible increase or decrease of the risk margin percentage in coordination with the inclusion or exclusion of certain products in order to establish the most optimal capital requirement. This, in many respects, is a blank check. Not only does it allow for any conceivable percentage of risk margin, it simultaneously opens up multiple combinations of inputs. The Commission now states that any of the possible outcomes along this sliding scale would have been a logical outgrowth. It's the equivalent of saying that the final capital rule is a logical outgrowth because it imposes any capital requirements at all, and that simply cannot be the case under the intent and plain reading of the principle of logical outgrowth. Where did the Commission end up? The Commission decides today to set the multiplier for the uncleared swaps of FCM swap dealers at 2% rather than the originally proposed 8%. The Commission also is modifying the final rule from the proposal to remove security-based swaps, proprietary futures, foreign futures, and cleared swaps from the risk margin amount calculation. These are significant changes from the 2016 proposal, and they are just one of the possible outcomes suggested in the reopening of the comment period. I'm not sure if 2% is the appropriate landing spot to insulate our markets from outsized risk, and based on the preamble to this final capital rule, I do not think the Commission is certain either. The preamble states the Commission does not have the data to determine whether or not 2% is the optimal or even adequate percentage. Instead, the Commission chooses 2% with the intent that the Commission decision to modify the final rule by removing cleared and uncleared security-based swaps, as well as proprietary futures, foreign futures, and cleared swaps positions from the risk margin amount calculation, and to set the multiplier at 2% should mitigate many of the commenters' concerns that the proposed 8% risk margin amount calculation was over-inclusive of the types of positions included in the calculation and was set at a percentage that was too high. Due to this lack of data, the Commission will need to conduct a 5-year post-implementation review to assess whether the minimum capital requirements for FCM swap dealers are adequately calibrated to ensure their safety and soundness. And I do applaud the Commission for including this critical regulatory component of the capital regime's implementation. However, this information is exactly the type of data that the Commission would have benefited from during the notice and comment process. By failing to issue a re-proposal in 2019, allowing just a few additional months of concrete, data-driven deliberation, which could have clearly stated a specific approach, we lost the opportunity to find out whether the minimum capital requirements that we selected are in fact adequately calibrated to ensure safety and soundness. I note that less than a month ago, the Commission voted to withdraw the Regulation Automated Trading Proposal, or Reg AT, the most recent iteration of which had been issued in November 2016, a couple of weeks before the 2016 proposal. At the same time that Regulation AT was withdrawn, the Commission issued a rebranded Electronic Trading Risk Principles proposal intended to, quote, accomplish a similar goal to the original Reg AT. Following the logic set forth today for the final capital rule, the Commission could have simply issued a final rule for electronic trading risk principles last month, arguing that it was merely a logical outgrowth of the latest iteration of Reg AT. While I disagreed with last month's policy decision, procedurally the Commission did the right thing under the APA. We should have followed the same procedure for capital and issued a re-proposal. If we had done so last December, we could have received meaningful comments from market participants on a clearly stated proposed re-proposal, and we could well have been positioned to finalize a stronger, more carefully considered final capital rule today that addresses current market conditions in a manner that is more data-driven. Before I conclude, I'd like to thank again staff from the Division of Swap Dealer and Intermediary Oversight for their excellent work on this highly technical and complex rulemaking and their willingness and time to take and answer my questions and take feedback. While I would have liked to stand with my fellow commissioners today, I cannot justify it under these circumstances. I truly wish I could support today's Commission action as we mark the 10th anniversary of the Dodd-Frank Act this week. To reiterate sentiments made in my first speech as a CFTC Commissioner, capital is a cornerstone financial crisis reform that is critical to protecting our financial institutions and our financial system as a whole from systemic risk and contagion. But it's also critical to protection from unintended consequences if capital and margin levels are applied and set without due regard to the uniqueness of our financial markets and market participants. I appreciate that in moving forward, we must fulfill our directive to establish capital standards appropriately and in consideration of other activities engaged in by swap dealers and major swap participants, such that we ensure that we do not penalize commercial end users who need choices and benefit from competition in our markets. At the same time, we must heed congressional intent without any compromise, regardless of what we think is best, remaining cognizant of the impact that capital requirements have on market stability, and most importantly, following APA rulemaking requirements when we do so. Shortly before the Commission voted on the reopening in December 2019, Chairman Tarbert gave remarks about transparency, making very powerful and important points about the incredible importance of being mindful as regulators of not only what we do, but how we do it. Chairman ended that particular statement with a powerful quote from Aristotle, and among many profound lessons from the Greek philosopher, he is also sometimes credited with the statement that, quote, patience is bitter, but its fruit is sweet. In that vein, I simply wish the Commission had devoted a little bit more time to how we fulfill this foundational Dodd-Frank requirements. The road has been long, far too long in many respects, but unsure of what deadlines we are racing to meet at this point or targets we are aiming to hit, I feel strongly the Commission and our markets would have stood on sturdier ground and perhaps even have landed at the same conclusion voted on today if we had practiced a little patience. Thank you, Mr. Chairman. Thanks again to the team and everyone for organizing today's meeting.
Thank you very much, Commissioner Benham. I've been told this is a sort of an announcement regarding the broadcast here, that those that are listening on the phone have continued to listen uninterrupted, as well as those that are listening via our YouTube broadcast. However, those that have been listening to the web stream or viewing this through the web stream on our website, we've had some technical difficulties. So what I would suggest, if possible, is for us to take a quick 2-minute sort of pause, and anyone that is on the web stream from our website, which is sort of going in and out, to please either dial into the phone number or go to the YouTube website to view this. At the conclusion of this meeting, there will be the YouTube recording will be complete and up. So those that want to listen to the entire meeting can do so. We'll just take a brief pause, and then I will go to Commissioner Stump. Okay, Commissioner Stump, the floor is yours.
Thank you, Mr. Chairman. I don't have any additional questions, so I will just move to make a very brief closing statement. I want to, again, commend the staff from the Division of Swap Dealer and Intermediary Oversight, especially Director Sterling, Jennifer Bauer, Rafael Martinez, Josh Beal, and Tom Smith. Many of you have worked on this rule for quite a long time, and your efforts are noted and appreciated. I'm pleased to support the finalization of this rule, and while I don't want to speak prematurely, I do wish to take this opportunity to congratulate the entire staff at the CFTC on completing the substantive Dodd-Frank rulemaking so that we can now turn our attention to fine-tuning these requirements to ensure the intended results are indeed achieved. I do recall, and many have mentioned, the 10-year anniversary of signing Dodd-Frank into law was yesterday. I recall shortly after that time being invited to the CFTC by then Chairman Gary Gensler for a social event at the agency to commemorate the signing of the legislation. It is unfortunate that today we're not able to meet in person and commemorate the finalization of the rulemakings that the CFTC has been engaged in for 10 very long years. But at some point, I do hope that we will be able to do that and that the staff will receive the due appreciation that they are owed from the commission and the participants in the market, as well as the many people who have come and gone from the commission over the years. With that, Mr. Chairman, I will turn it back to you. Thank you. Mr. Chairman, are you there? Hello?
This is Director Sterling. Is the Secretariat available if the Chairman's not?
Yes, this is the Secretary. I'm still on the line, and Commissioner Stump, I was hearing you just fine. I think we're just waiting to hear from the Chairman.
Great, thank you.
I don't know, this is Commissioner Berkowitz. I don't know if there's, where there's a significant thunderstorm where I am in Bethesda. I don't know if that's affecting transmission or not.
Yes, I can confirm the same where I am, Commissioner Berkowitz. So that may in fact be the issue.
Thank you, everyone, for your patience. This is the Secretary speaking again. We do have word that the Chairman is reconnecting to the call.
This is Chairman Tarbert. Mr. Kirkpatrick, this is Chairman Tarbert. Can you hear me?
I can, and very good to have you back, so I will turn it back over to you.
Thank you very much. Commissioner Stump, did you finish your statement?
I did, and I believe that it was heard by most and recorded for the benefit of subsequent review. Is that correct, Mr. Secretariat?
Yes, that's right. The recording is working fine, as well as anyone who is listening on the phone or via YouTube. So I believe we are ready. Mr. Chairman, if you're ready to go next to Commissioner Berkowitz.
Yes, please. And I should note for everyone that's on the line and listening, there appears to be a severe weather pattern coming through the D.C. area, which may have knocked me off the call. So if you get knocked off, we'll wait patiently to get you back on. So with that, I'll hand it to you, Commissioner Berkowitz.
Thank you, Mr. Chairman. The sky is sort of a dark greenish gray, and some of the lights have just gone out. If I lose, if it becomes too noisy in the rain or whatever, please let me know. I'm going to, my understanding is I've gotten word that some of the transmission was lost or started to be lost during my questioning. So I'm going to just summarize very quickly my takeaway from my first round, for those who might have missed some of the answers, and then make some observations. I initially had a written statement, but that I was going to read, but that's going to be available on the website. So I have a couple of other observations. The point that the discussion on the first round, when I think the transmission was lost, regarded whether any of the approaches, the extent to which the three approaches would require additional capital to be raised by any of the entities. And I'm just going to summarize that. I'm going to read from the cost-benefits consideration in three places. Encourage persons who are listening to read the entire discussion so they get the full context of this. But the critical passages for swap dealers that are FCM and ANC firms with the SEC. So there's 4 swap dealers that are FCMs identified here in the cost-benefit analysis. And the document, which either is or will be available on the website, states, this is in Appendix A to the document, the Commission expects that the likelihood of these entities needing to raise additional capital due to this rule might be low. With respect to the banks who use the swap dealers that are affiliates of banks that use the bank-based capital approach, the document states, quote, the additional CET1 Tier 1 capital required from the Commission's capital requirement may not be significant, as it may be possible for the consolidated entity to keep the same level of capital within the bank holding company, but just reallocate among its subsidiaries. We had a good discussion on that, good Q&A with the staff, so if you want further explanation of the other effects that was in that discussion, but no additional capital is required, they can reallocate it. And then finally, for the third approach, the tangible net worth approach, it states, the Commission estimates that currently 3 or 4 SDs would be in this category and believes that their tangible net worth greatly exceeds the Commission's requirement. There was also a very helpful discussion, Q&A on the state of the current data and why we don't have as good as information now in establishing these capital requirements as we had in 2003 when we established the capital requirements for FCMs. And it's partially a chicken and an egg question that the data regarding the impact of unique capital requirements, basically, as I understand it, unique capital requirements to be able to judge what the effect of those capital requirements are and whether you need, whether they are adequate. Just getting data from swap dealers in the absence of capital requirements would not be optimally informative as to the status and the state it would have if you had those capital requirements. So we're now imposing the capital requirements, and we're going to get the data, and then going forward we can evaluate the adequacy of the capital requirements based on that data. So with that in mind, we're establishing capital requirements are going to basically, to a certain extent, not require any additional capital for these entities, but we're going to get information to determine whether the current state is adequate. I do not view this as the completion of the capital requirements. I view this as yet another stage in their extremely long development. Why we didn't do this earlier, I certainly at the Commission earlier, and I think the answer is it's a very difficult subject, but the fact is we're not there yet, and we're not at the end of the road on this yet. And I just want to make another observation regarding a couple of the comments of my esteemed colleagues, and I appreciate their viewpoints on this, and I think there is a difference. One of the objectives that's been articulated underlying the approach today, and it's in the document, is to maintain competitiveness of various entities in these markets, not to disadvantage one versus the other, and not to impose really significant costs that might severely impact the business of those entities. And I certainly, as long as I've been on the Commission, I've been very concerned about the number of FCMs in both the futures business and the swaps business. And I've supported various measures to remove unnecessary regulatory obstacles to the competitiveness of FCMs. And I think that is something very important to do. We need FCMs, obviously, intermediaries are critical, and having a competitive landscape of FCMs is critical to provide end users with sufficient options in participating in these markets, and it's also critical for reducing a systemic risk in terms of the concentration of the FCM. So I've consistently supported measures to reduce unnecessary regulatory burdens on FCMs. I'm very wary of considering capital requirements in that category as unnecessary regulatory burdens. And I think we need to be very, very careful when we adjust the capital requirements to accomplish that objective. So we're going to be holding the status quo right now and then seeing how it is. But it's interesting. On this is the 10th anniversary, and yesterday there was a symposium or a web forum, which unfortunately, due to the preparation of this a meeting, I couldn't really focus on, and that was a forum sponsored by George Washington University and Better Markets. And one of the speakers at the Better Markets GW forum yesterday was John Reed, the former CEO of Citigroup. And I wanted to listen to him, but I've heard him speak in his perspective on the financial crisis before and what caused it. And being the head of Citigroup, he certainly had a front row seat. And he described, and it's been described elsewhere, the inexorable pressures to the competitive pressures and the need to maintain, for the banking industry back in those days, to maintain with shadow banking industry, to be competitive with other new forms of banking, and the legislative and regulatory response is to adjust the regulatory system and the laws applying to the banking industry to enable banks to be competitive and compete with those other forms of financial services is a significant factor that led to the crisis. I mean, you talk about money markets, you talk about mortgages, you talk about all sorts of regulations that banks were subject to, that other entities were not subject to, and so the banks came to the Congress and to the regulators and say, you have to loosen up your regulations to allow us to compete. We can't compete, we can't get the return, it's too costly. And that inexorable march, and you look at each individual regulatory decision in hindsight, and you can sort of see how it led to what it eventually led to. Of course, sitting there at the time, you didn't have the crystal ball going forward. And I say that just as a lesson learned. When we do these things, yes, it's important to maintain FCM competitiveness. Yes, it's important to maintain robust intermediaries and not impose unnecessary costs. But at the same time, we have to be mindful that we have a mandate from Congress to impose risk-based standards, and we cannot sacrifice those in the name of competitiveness. So there's an appropriate balance, and I think we can draw the line at different places. For the reasons I've articulated in my written statement, specifically on this rule, I'm going to dissent, and I have concerns about the two other rules coming up as well, which we will have. We look forward to the discussions on those. So thank you very much. I respectfully will be dissenting.
Thank you very much, Commissioner Berkovitz. Well, with that, I'll ask the question, is there any commissioner not prepared to vote? Okay, hearing none, I will go ahead and ask our Secretary, Mr. Kirkpatrick, to please call the roll for the vote to adopt the final capital and financial reporting rule for swap dealers and major swap participants.
Thank you, Mr. Chairman. This is the Secretary speaking. The motion now before the Commission is on the adoption of the final rule on capital and financial reporting requirements for swap dealers and major swap participants. Commissioner Berkovitz.
Commissioner Berkovitz votes no.
Commissioner Berkovitz votes no. Commissioner Stump.
Commissioner Stump votes aye.
Commissioner Stump votes aye. Commissioner Benham.
Commissioner Benham votes no.
Commissioner Benham votes no. Commissioner Quintens.
Commissioner Quintens votes aye.
Commissioner Quintens votes aye. Chairman Tarbert.
Chairman Tarbert votes aye.
Chairman Tarbert votes aye. Mr. Chairman, on this matter, the ayes have 3, the noes have 2.
Thank you very much, Mr. Secretary. The ayes have it, and the motion to adopt the final rule is hereby approved. We're now going to turn to our second agenda item, which is to hear a staff presentation on the proposed rules concerning margin for uncleared swaps. Commissioners can ask questions following the presentation. While we're not going to vote on the proposals today, hearing from staff will help frame our consideration of the issues and will keep the public informed about Commission business. At this time, I'd like to welcome the following staff for their presentation on today's proposals. Also from the staff of the Division of Swap Dealer and Intermediary Oversight, we have with us Director Josh Sterling, Associate Director Warren Gorlick, Special Counsel Carmen Moncada-Terry, and Special Counsel Lily Bahovanova. The floor is yours.
Well, thank you, Mr. Chairman. Hello again, Commissioners. Director Sterling here. I have very little to say here because I stand, as I always do, in silence, stunned silence, while my expert team leads the way, as they certainly have on capital just now and will here in these explanations. So these are some very strong proposals. We have many people to thank, and we're very glad to talk to you about them. And with that, I will hand it over to Warren, who, along with Carmen and Lily on my staff, have done just an excellent job. Carmen Moncada-Terry and Lily Bahovanova. So, Warren, sir.
Thank you. Thank you, Josh, and thank you, Mr. Chairman, Commissioners, and fellow staff. I am Warren Gorlick, Associate Director in the Division of Swap Dealer and Intermediary Oversight. In addition to Director Sterling, I'm joined today by my colleagues, as Director Sterling just said, Carmen Moncada-Terry and Lily Bahovanova, both of whom will also speak on other rule proposals before you today. I would also like to recognize the assistance and support we received from the offices of General Counsel and Chief Economist. Today, we are pleased to present a proposed rulemaking concerning the CFTC's margin requirements. Let me begin with the proposal to amend the definition of material swap exposure, which we sometimes refer to as MSE, in Commission Regulation 23.151. As you know, Commission Regulation 23.161 sets forth a schedule for compliance with the CFTC's initial margin, sometimes referred to as our IM rules, spanning from September 1, 2016 to September 1, 2021. The last phase of compliance that we refer to as Phase 6 begins on September 1, 2021, and brings within the scope of compliance within the IM requirements financial end users with MSE that have more than $8 billion in average aggregate notional amounts that we often refer to as the ANA calculation. This ANA calculation determines whether financial end users have MSE and the timing for compliance for entities coming into the scope of the IM requirements after the end of the phase-in compliance schedule, and differs from the BCBS IOSCO margin framework for non-cleared OTC derivatives. In particular, the BCBS IOSCO framework requires the use of the March, April, and May period of the current year to calculate ANA to determine whether entities come within the scope of compliance with the IM requirements, with the compliance date set at September 1st of each year. By contrast, the Commission's margin rule requires that ANA for financial end users be calculated using June, July, and August period of the prior year, with compliance to begin for entities coming into scope in Phase 6 beginning September 1st, 2021, and after the end of the phase-in compliance schedule beginning January 1st of each succeeding year. Market participants have stated that this divergence from the agreed international approach imposes an undue burden on their efforts to comply with the margin requirements. Entities have to account for different compliance schedules and set up and maintain separate processes for determining when they meet the thresholds for IM compliance. DSIO therefore recommends amending the definition of material swaps exposure in Commission Regulation 23.151 to revise the period for calculation of ANA for determining whether an entity has in fact, MSE. Consistent with the BCBS IOSCO framework, the annual calculation period of June, July, and August of the prior year would be replaced with March, April, May of the current year. In addition, September 1st would be set as the date for the determination of material swaps exposure for all succeeding years. Harmonizing the annual calculation period and the timing of compliance for entities coming into scope after the end of the phase-in schedule with the international standard would reduce complexity, as firms would no longer need to undertake separate annual calculations using different compliance periods, nor would market participants need to conform to two separate compliance timings, varying according to the location of their swap counterparties and jurisdictional requirements applicable to the counterparties. Thank you for your attention. Before answering questions, I would like to turn your attention to another aspect of the proposed rulemaking that will be explained by my colleague, Carmen Moncada-Terry.
Thank you, Warren. Let's turn to the proposal to amend Commission Regulation 23154A, which requires swap dealers and major swap participants subject to the CFTC margin rule or covered swap entities to calculate the amount of initial margin to be collected from a counterparty that is a CFTC registered swap dealer or major swap participant. The proposed amendment, which is consistent with CFTC No Action Letter 1929, sets forth an alternative method for the calculation of initial margin. The proposed amendment would permit covered swap entities to use the risk-based model calculation of IM of a counterparty that is a CFTC registered swap dealer or major swap participant to determine the amount of initial margin that must be collected from the counterparty, and to determine whether documentation concerning the collection, posting, and custody of initial margin is required. It is expected that the proposed alternative method of calculation will be used by covered swap entities that mostly trade swaps with non-swap dealers and major swap participants, and that hedge the risk of swaps by entering into offsetting swaps with a few CFTC registered swap dealers and major swap participants. Given the discrete and limited nature of their swap activities, the covered swap entities will likely forego the adoption of a risk-based model to calculate initial margin and opt to use the standardized initial margin table. DSIO believes that under these circumstances, it is appropriate to make available the alternative method of calculation of initial margin to covered swap entities that enter into swaps with CFTC registered swap dealers and major swap participants for the purpose of hedging their swaps exposure. In the absence of this alternative method of calculation, covered swap entities may limit their swap trading with non-swap dealers or major swap participants, reducing the availability of hedging alternatives. Or the covered swap entities may enter into swaps with non-swap dealers and major swap participants and assume the unhedged risk, or enter into derivative transactions that do not effectively address the risk of their swaps. DSIO recommends the proposed amendment to Commission Regulation 23154A to provide for the alternative method of calculation of initial margin, which would allow a covered swap entity to use the risk-based model calculation of initial margin of a counterparty that is a CFTC registered swap dealer or major swap participant to determine the amount of initial margin that must be collected from such counterparty. Thank you for your attention. Now, I'd like to turn your attention to another notice of proposed rulemaking, which will be presented by my colleague, Lilia Bosanova.
Thank you, Carmen, and good afternoon. I'm Lilia Bosanova, Special Counsel in the Division of Swap Dealer and Intermediary Oversight. Like my colleagues, I also want to start by recognizing the invaluable assistance we received from the Office of the General Counsel and the Office of the Chief Economist. And we are pleased to present another notice of proposed rulemaking to amend the CFTC margin rule to permit the application of a minimum transfer amount, or MTA, of up to $50,000 for each separately managed account, or SMA, of a legal entity, and separately, to recognize the swap dealers and major swap participants can apply separate MTAs for initial margin and variation margin. Minimum transfer amount is currently defined under the CFTC margin rule as a combined amount of initial and variation margin not exceeding $500,000, under which no exchange of initial or variation margin is required. The purpose of the MTA is to alleviate the operational burdens associated with making de minimis margin transfers. During the implementation of the CFTC margin rule, market participants identified certain operational and compliance burdens associated with the application of the MTA. And to mitigate these burdens, the Division of Swap Dealer and Intermediary Oversight issued two no-action letters, 1712 and 1925. The notice of proposed rulemaking before you today proposes amendments consistent with these two no-action letters. In line with the no-action position set forth in 1712, the proposed rulemaking proposes to revise the definition of MTA to permit swap dealers and major swap participants subject to the CFTC margin rule, we refer to those as covered swap entities, to apply an MTA of up to $50,000 to each SMA of a counterparty that owns two or more SMAs. And the proposed rulemaking also proposes to define the term SMA, or separately managed account, and provides for conforming changes to the CFTC margin rule to incorporate the proposed definition of MTA. The purpose of the proposed amendments is to address the practical challenges in the calculation of MTA across the SMAs. Specifically, given that each SMA operates independently, the asset manager's authority, including with respect to collateral management, is limited to assets under each asset manager's management, and that the asset managers, due to a duty of confidentiality among other reasons, do not share information about the separate accounts. It is impractical to aggregate initial and variation margin obligation across the SMAs to determine whether the MTA has been exceeded. And by providing for a separate MTA for each SMA, the amendments would eliminate the need for aggregation. Separately, the proposed rulemaking proposes to amend the documentation requirements of the CFTC margin rule, consistent with the no-action position set forth in Letter 1925, to recognize that the covered swap entity may apply separate MTAs for initial margin and variation margin with each counterparty, provided the combined initial and variation margin MTA does not exceed the MTA. The proposed amendments would permit covered swap entities and their counterparties to maintain separate settlement workflows for initial and variation margin, which reflect the different segregation treatments for initial and variation margin under the CFTC margin rule. Staff recommends that the Commission issue the notice of proposed rulemaking for public comment. Staff believes that the proposed amendments would advance the Commission's efforts to facilitate the implementation and administration of margin requirements without significantly increasing the level of uncollateralized credit risk. Staff also believes that the proposed rulemakings, amendments which reflect the conditions set forth in letters 1712 and 1925 would provide legal certainty and facilitate market participants' efforts to take into account the application of the CFTC regulations in their planning of uncleared swap activities without undermining the effectiveness of the regulation. Thank you for your attention, and we would be happy to discuss any questions you may have.
Well, thank you very much, first of all, Josh, but especially to Warren, Carmen, and Lily. That was really a set of informative presentations. And they will aid our commission as we consider those proposed rulemakings. It's also beneficial for members of the public and market participants who are listening to today's meeting. I'm going to go ahead and open the floor, and we'll just go down the line from commissioners for any questions or comments they may have on these proposals that will be coming to the commission shortly. I would just like to thank everyone for your work on this and also acknowledge the role that the GMAC subcommittee played in making a number of recommendations, some of which we will sort of be reflected in the proposals that the DSIO staff will be presenting to the Commission. So no questions from me, but just want to thank you for your really hard work. Commissioner Quintens?
Chairman, just two quick questions. The first is on 23-154A relief. What types of swap dealers does DSIO anticipate would benefit from that proposed relief that would allow the swap dealer to rely on a counterparty swap dealer's IM calculations? And are there particular types of counterparties DSIO believes that those swap dealers are likely to service?
This is Carmen. Likely smaller swap dealers that service niche segments of the swap markets, like physical commodity swaps and end users.
And end users, Carmen, was that the end of what you said? Okay,
yes,
thank you for that. I think that's an important expectation that frames out at least my interest in proceeding with this. The second question is on the MTA proposal. Is that a proposal that to apply those separate minimum transfer amounts for IM and VM, our regulations with other jurisdictions?
Thank you, Commissioner, for this question. This is Lily Bajanova speaking. The answer is yes. The proposed amendments would align the CFTC requirements with respect to the MTA with the European Union requirements, which expressly provide that the counterparties can agree on separate MTAs, provided the sum of those MTAs doesn't exceed 500,000 euros. So in that respect, our approach is consistent.
Okay, wonderful. Thank you. That's all the questions I have. I appreciate the hard work of this team and your interest in engaging with me in my office on our issues. So thanks again. Thank you, Mr. Chairman.
Thank you.
Thank you very much. Commissioner Benham?
Thanks, Mr. Chairman. And again, echoing your comments, and Commissioner Quintens, want to thank the team, Warren, Carmen, Lilia, and of course the director for your work and engagement with my office. I know we've had a number of back and forths on this, some basic questions, and these are NPRM, so I'm certainly looking forward to the public commenting on these two proposals. And I said this multiple times, these are at the heart of codifying no action relief, which we've been doing a lot in the recent past, and I think that's a very positive thing for both the agency and creating certainty for market participants. Also, would like to recognize and commend Commissioner Stump for her work through the GMAC and making some of these recommendations. I only have one question with respect to 23-154, and it's about the modeling. And I think in the proposal, and please correct me if I'm wrong, but DSIO sort of recognized that there was some concern about the swap entity's risk-based model calculation, and to sort of offset the concerns that the NPRM implements, I'm going to call them safeguards. And I know we discussed this a little bit, but the model being approved by the CFTC, the NFA, or prudential regulator, as one, and then the covered swap entities are only allowed to take this approach if the uncleared swaps are for the purposes of hedging its own risk. Is there anything else in that space that is worth noting for me or the public? I appreciate your recognizing the risk of being a little bit more flexible on the model, but implementing some safeguards, some sideboards to call them, to ensure that we're assessing this risk properly and accounting for margin as needed. Thanks.
Thank you for the question. This is Carmen. I think it is important to note that this particular alternative method calculation of initial margin, it's only available with respect to two types of parties: a covered swap entity that enters into transactions to offset swaps previously entered with non-swap dealers or non-major swap participants, and that enters into a transaction with a swap dealer, a major swap participant, to offset the risk of those transactions. And the counterparty, the swap dealer and major swap participant, whose IM calculation is going to be used to determine how much initial margin must be collected from such counterparty, it is also subject to risk management requirements under 23-600. That particular counterparty it's required to adopt a risk management program that allows it to manage and monitor risk associated with its swaps, including risk associated with its swaps, including it must account. The program must account for credit risk, market risk, in addition to legal risk associated with the swaps. So we believe that it's the fact that the counterparty that is going to be calculating the initial margin, it's a good mitigant concerning regarding any concerns arising with respect to the use of the alternative method of calculation.
Thank you, Carmen. I appreciate that, and I appreciate you including this in the proposal. And again, look forward to the public's comment and moving forward with this. I'm happy to support both today. Well, I guess next week, Mr. Chairman. Sorry. Back to you, Mr. Chairman. Thanks.
Thank you very much, Commissioner Benham. Commissioner Stump.
Thanks, Mr. Chairman. I want to take just a few minutes here to give a special thanks to this team in particular. I spent the past few months working with Carmen and Warren with the GMAC on a report that the GMAC submitted to the agency, and I think they have handled it remarkably well. We could not have produced a report without them. I want to also note that they were able to pull these recommendations together in relatively short order, and I am very grateful. So I also want to thank my fellow commissioners for working with me on these matters that we're dealing with today or hearing about today. From my perspective, these two proposals are, I consider them to be cleanup, and I think they will better ensure compliance. And I think we should always ensure that our rules can be complied with in a reasonable way. And I think that's what these two rules seek to achieve. And I hope that we can continue to work together to address many of the other recommendations that were included in the GMAC report that was recently sent to the Commission. I'd like to say just a few words, if I could, about why we need to be thoughtfully considering some of these other recommendations in the report. To be clear, I am not advocating for a rollback of uncleared margin regulations that are today applied to the largest financial institutions that are engaged in swaps with one another. Rather, as these regulations are just now, being applied to a new set of financial end users, we have a responsibility to ensure that they are fit for that purpose. Title VII of Dodd-Frank dealt with many complex provisions and major changes to swap market structure. Having been present for the development of the legislation in 2009 and 2010, my recollection is that the vast majority of the concepts debated prior to the passage of Dodd-Frank, at least those applicable to the derivatives markets, were broadly supported. And the bulk of the hand-wringing and the consternation and the anxiousness was limited to only a few provisions, most of which centered on concerns from lawmakers about how the new requirements being necessarily applied to the largest banks would be extended to impact end users and whether that might present some practical challenges. So here we are 10 years later, and some might be surprised that we continue to struggle with this. But the reality is that only now are these uncleared margin provisions being phased in to apply to certain end users. So it really should not come as a surprise that now is the time to thoughtfully consider whether rules designed to ensure the exchange of margin between the largest financial institutions need to be tailored to account for the exchange of margin in which one of the counterparties is an insurance provider, a pension manager, a mortgage service provider, or another type of end user. And the GMAC report recommends several actions beyond those we're considering today, and the Commission should consider those to address the unique challenges associated with the application of the uncleared margin regulations to end users that are just now coming into scope. These are challenges that caused uneasiness in 2010, but are becoming more evident in 2020. So again, with that, I don't have any questions. I am very pleased that we are thoughtfully considering these, and I look forward to supporting the two measures that have been described today, actually 3 measures that have been described today, and I stand ready and willing to answer any questions from any of my colleagues if that is helpful as well. Thank you.
Thank you very much, Commissioner Stump. Commissioner Berkovitz.
Thank you, Mr. Chairman. Just have a few, hopefully, straightforward questions, and I too would like to express my appreciation to the members of the GMAC who put a significant amount of work and effort into making the recommendations for us to consider these. Commissioner Stump for her leadership of that committee and bringing these forward, and this is the a process, a very worthwhile process that we have of the advisory committees getting input and feedback on our regulations and what we can do to improve them. So I'm glad we're considering these in the appropriate way through a notice and comment rulemaking. And in terms of some of the rules specifically, on the 23.151, which is the material swaps exposure rulemaking, is it the case that we're going to be conforming with these calculation periods with the BCBS IOSCO with the way these margin the aggregate, the AA, and I'm using all these acronyms, are calculated is considered consistent with BCBS IOSCO, but right now the Federal Reserve or our banking regulators are using what we're using. So is there a difference there between what we're conforming to? Could you sort of review that landscape, please?
Yes, that's correct, Commissioner. This is Warren Gorelick. It is the case that by conforming the calculation period for ANA, the average aggregate notional amount, and using March, April, May, rather than the existing June, July, August that both we, the CFTC, as well as the U.S. prudential regulators currently use. So we are, by moving to March, April, May, the international standard, we're conforming with the internet. We, by definition, then conform to BCBS IOSCO and what most other jurisdictions do. Now, it is the case that the prudentials haven't done anything in this area. We have discussed what they're doing. They're certainly not opposed to us moving forward on this. They haven't done their own rule proposal. They're engaged in various other challenging issues with margin, not least inter-affiliate margin and things like that. So they haven't moved forward. And there was some indication that there's also the possibility that they might not even need to do the kind of rulemaking that we're doing, that it's possible they could just do it through some kind of supervisory guidance process. But in any event, when we informed them of the move to March, April, May, they did not object to us going there. And there won't be any particular conflict if a financial end user is doing a swap with a CSE, that is to say a covered swap entity subject to the CFTC's margin requirements, then they will have to use the March, April, May period. And it's possible that if that same financial end user is doing a swap with a prudentially regulated swap dealer, it's certainly at least a possibility that the prudential regulators might permit them to use the same calculation period that they used for the CFTCs, because there shouldn't be any major substantive difference in doing so.
Right, that was going to be my next question. There's my understanding is there's not a the prudential regulators who may or may not move on this to be consistent. It's not that they think they're necessarily that their way is better or that this way is worse or more risky or has some substantive disadvantages. It's just the way, it's not a priority for them to move at this time. So we're not doing something that the prudential regulators would be saying we shouldn't be doing or should not be done.
That's correct, Commissioner. In fact, they specifically said they had no objection to us moving forward in this area.
Okay, thank you. That's helpful. So let me move to the NPRM for the alternative initial margin calculation method. And I understand that you've had discussions with my office on this, and I'm happy. I think those have gone very well. But I just want to confirm the amendment essentially, or the regulatory amendment codifies no action relief that was previously provided, but it's not codifying all of the conditions in that no action relief. Specifically, the no action relief that was granted provided a specific provision that says that the condition of the no action relief that the entity relying on the relief would have to include steps to monitor, identify, and address potential shortfalls in the amounts of the initial margin generated by the counterparty on whose margin models that entity was relying. That condition, as I understand, is not, I understand, not explicitly in the rule, but is it your belief that other CFTC requirements adequately cover that and would in fact require that condition, even though it's not explicitly in this particular rule amendment?
Thank you, Commissioner. This is Carmen. Yes, we believe that existing Commission regulations, in particular, Commission Regulation 23600, which imposes risk management requirements on covered entities, addresses that particular concern. That 23600 effectively requires covered entities to have a program to manage and monitor the risk that accounts for credit risk, market risk, and we expect that entities that elect to use the proposed alternative method of calculation of initial margin would continue to monitor the outputs produced by the counterparty of initial margin, and they will also monitor any shortfalls. And in fact, we believe that 23600 also would address that aspect that requires entities to provide to the CFTC notification if there are any adjustments to the initial margin. 23600 explicitly requires the filing with the CFTC of risk exposure reports, and we expect those exposure reports to include discussion concerning any adjustment to the initial margin produced by the counterparty.
Okay, thank you very much. That's very helpful, and I appreciate the work you've done with my office on that to make that clear, the responsibilities under 23-600. My final question goes to the minimum transfer amount. And here again, as I understand it, the current rules apply to a combined amount of IM and variation margin across accounts not exceeding $500,000. And under the proposal, the minimum transfer amount would be $50,000 for each separately managed account. So, what is there? So, would there be a possibility that you would have multiple accounts of 50,000 or less that would exceed the 500,000 that is the current, or do we think that this is going to potentially result in less margin, or that there could be a way to split up accounts and thereby avoid margin rules, or are there safeguards in there that designed to prevent that?
Thank you for this question, Commissioner. This is Lily Baujanova speaking. You're correct. Under the proposed amendments, the $50,000 limit can be applied to indefinite number of separately managed accounts. So in certain circumstances, it may be possible that the current $500,000 limit is exceeded. However, we believe there are a number of safeguards that would limit the potential risk, uncollateralized risk, and the delay in the exchange of margin. And in particular, with respect to your concern that there may be multiple separately managed accounts, as part of the definition of SMA, there is a condition that the proposed application of minimum transfer amount would only be available for separate accounts of an owner that are not subject to a collateral agreement that provide for the netting of initial and variation margin obligations across the separate accounts. So this limitation on netting across the accounts, combined with the fact that the minimum transfer amount thresholds are still set at a very low level, we believe that this would serve as a disincentive for separately managed account owners to fragment the investments across multiple accounts. In addition to that, there are certain safeguards embedded in Commission regulations, such as Commission Regulation 23-600, which was previously mentioned, that requires covered swap entities to establish a risk management program for the monitoring and management of risk associated with their swap activities, and as part of that, account for the credit risk and set risk tolerance limits. So even though in certain limited circumstances there may be a delay in the exchange of margin or a certain increase in the uncollateralized risk, we believe that these safeguards exist to limit the risk, and it would be generally negligible given that the MTAs are still kept at a very low level and these safeguards exist.
Okay, thank you very much. I appreciate that, and I appreciate the effort that you and the team have put into ensuring that these changes have appropriate safeguards so that they will achieve their intended purpose and provide the intended flexibility without opening the door to abuse. And in that manner, the majority of market participants, I'm sure, would use these as intended, but we don't want to draft them to allow the few others to game the system or whatever. So I appreciate the work you've done on this to make these robust and workable with appropriate safeguards, and I look forward to a public comment on each of them. Thank you again.
Thank you.
Thank you very much, Commissioner Berkovitz. Before we move to anybody that would like to make closing statements, I wanted to just briefly announce again that the YouTube archive of this meeting will be fully available after this meeting. So to the extent your transmission or listening was interrupted at any point, you can go back and see the entire meeting on the YouTube channel. So with that, for commissioners to make closing statements, we will begin in reverse seniority order so that we hand it back to you again, Commissioner Berkovitz.
Well, thank you, Mr. Chairman, and I don't have any more substantive comments on these rules. I think it's been a productive day. I look forward to considering the comments on each of these notices of proposed rulemaking. And I want to thank the staff. I want to thank Josh and Josh Sterling and the DSIO team for Josh Beal, Tom Smith, the team that worked on so hard over so many years. And if I left out anybody's name, I totally apologize. I don't have that email in front of me for the entire team's name. But the capital rule team, it's an incredibly complex subject. Been at it for many, many years. And although I believe there may be a few more years to go on it, I do want to recognize all the work that has been put in to date on a very, very difficult subject. So thank you for all that work. And I thank the other team members who have worked on these notices of proposed rulemaking. And of course, I want to acknowledge my staff as well for the work that it takes to get up to speed and provide all the comments and feedback and get the initial briefings on these matters. Again, we do one of these rulemaking meetings in a few hours, but that is just a fraction of the time it takes to really consider each of these matters. And so I want to express a great appreciation to everyone in my office, Eric, who had the primary responsibility on the capital rules, Eric Remler and Sebastian Peugeot on these other NPRMs, and Lucy Hine, who worked on all these matters as well and helped keep all the other trains running while we're doing this. And James Janison, my very helpful student who's interning with my office this summer. So thanks to everybody who worked on these, and I look forward to tomorrow's meeting as well.
Thank you very much, Commissioner Berkovitz. Commissioner Stump.
Thank you, Mr. Chairman. I don't have any formal closing remarks. I was thinking as we were working through this week's agenda that, there is nothing that the CFTC does that is not complicated and not technical. And we are very blessed by a team of people. It may be a small team, it may be a small agency, but we are quite well served by the few people we have who are dedicated and committed to these issues, and I'm very grateful for that. So I won't thank everyone by name, but I do think we punch above our weight when it comes to these issues, and I'm very proud to work with everyone at the agency. So thank you so much to everyone who has been working tirelessly over the past 10 years, but particularly over the past few weeks. Thank you.
Thank you very much, Commissioner Stump. Commissioner Benham.
Thanks, Mr. Chairman. Just repeat big thanks to the DSIO team, Josh Sterling and Tom and Josh and Raphael and Jennifer Bauer as well. Huge accomplishment has been said so far, 10 years in the making, and should all be very proud of this day to get this through and done. So thanks to all of you, and recognize my team as well, Casey McLaren, legal intern with me this summer, Laura Gordy, David Gillers, and John Duffy. As Commissioner Berkovitz said, couldn't do it without them. So appreciate it and look forward to tomorrow's meeting as well. Thanks, Mr. Chairman.
Thank you, Commissioner Benham. Commissioner Quintan.
Thank you, Mr. Chairman. I, like my colleagues, would just like to extend a heartfelt thanks and sincere congratulations to Tom Smith and Josh Beal, Raphael, Jennifer, and also to Josh Sterling for this remarkable product that we have in front of us today and the conclusion of all of this work. And it is my belief that this rule has a strong chance of standing the test of time. I think the thing that may challenge that longevity will be revisiting it through subsequent and robust data analysis, which is appropriate. I think one thing that will not challenge its longevity is any concern around the APA or procedural mechanisms. I have a high degree of confidence in the legal analysis that our Office of General Counsel provides on this and every other rule to ensure that we are abiding by the APA. After 3 proposals, 200 comments, I think we have enormously sufficient grounds to have done what we did, which was in the scope of everything we've already considered. I would also like to note that one of the concern areas that I had targeted, which was trying to align the risk management amount percentage against tentative net equity as opposed to adjusted net equity, was something that the APA likely would not have allowed. So it is not the case that we threw the APA out with this process, even though maybe someone or others. I'm sorry, I think my phone
we can hear you.
A minute. Thank you.
Commissioner Quintens, I can't hear you any longer. Commissioner Quintens? Commissioner Quintens, we're having a very difficult time, or at least I am hearing you.
Done that consistently here. Notably including the mayor. Mr. Chairman, thank you for today.
Commissioner Quintens? Commissioner Quintens, this is Chairman Tarbert. Do you read me?
Mr. Chairman, can you hear me?
Yes. Could you go ahead and repeat? I think you were referring to the APA, and go, just repeat everything after that, including, I think, thanking your staff. Your line got very, very low, and I and other commissioners had trouble hearing you.
Thank you for that, and I apologize for that. I was just saying, I think one of the things that won't challenge the longevity of this rule will be any concerns around the APA. I have strong confidence in the legal analysis that OGC provides on this and every other rule. And in fact, one of the things that I would have liked to see this rule address, which was having the risk margin amount percentage target tentative net equity as opposed to adjusted net equity, was rule likely non-compliant with the APA. So I don't think it is the case that we disregarded the APA in this rule at all. But I, like anyone else, would totally encourage any responsible commission in the future to use data analysis to go back and revisit this as appropriate to appropriately calibrate capital, and not out of some sense of punishing specific entities or political calculations of what strong versus weak mean, since I think our descriptions of those are incredibly subjective and can actually mean countervailing things. And with that, Mr. Chairman, I'd just like to thank Margot Bailey of my staff, who is such an expert in this area in particular. I couldn't have gotten into this role without her expertise, and she's been instrumental in my assessment of capital ever since I arrived at the Commission, notably including in the SEC's discussion and deliberation of its capital rule, with which we had some significant input. And so with that, Mr. Chairman, thank you for your leadership, and I look forward to tomorrow as well.
Well, thank you very much, Commissioner Quintens. This is Chairman Tarbert. I just wanted to take a very brief moment in my closing remarks to just reflect on the last year. So this is the first time that we've met publicly after I finished my first year as on the commission. And of course, despite being chairman, I'm also the rookie on the commission because I've served the least amount of time. I just want to say that it has been a tremendous pleasure during this past year to serve on the commission. I couldn't have asked for a better set of colleagues, friends, and experts who are really dedicated to the job. And the CFTC is really a special place. The expertise that we see from our staff day in and day out is unparalleled. And I've had the chance to work in various offices in government and the private sector. And so it's a remarkable agency, and I'm privileged to have this role. On my one-year anniversary, or the day before and the days afterwards, I did a number of news articles or interviews just to talk about the tremendous amount of accomplishments that we've done together as an agency. I think at the end of this week, we will have had 14 open meetings, which is more than the last 6 years prior to us being together combined. A lot of open meetings. At the end of this week, I think we'll have something like 20 final rules and 20 proposed rules. So we've been incredibly busy, and I know it's taken its toll. And all of this during the coronavirus pandemic, where this agency, where the men and women of the staff and the commission have really stepped up. And so I've done my best to sort of highlight those in a number of articles. Of course, there was the Financial Times article that has been mentioned. And it was sort of intimated, I think, that I had said that the market is, or financial institutions have been yearning for our rules, and implying sort of we're tailoring our rules to what the financial industry wants. And I just want to be very clear on that point. First of all, my quote was, quote, "The market has been yearning for clarity to get things done for a long time now. It's 10 years after the Dodd-Frank Act. We need to close out those items on the punch list," unquote. And I just want to be very clear on that some some of those things, it may very well be that the industry likes. Some of them they have not liked and will not like. I think about the name give up rule that was pretty controversial. And then I also think about some of our aspects of the capital rule today. For example, the bank-based capital requirements, which, while it may not require any large bank holding companies to go to the market to raise capital, it would require these bank holding companies to put capital in those subsidiaries that are swap dealers, the ones that we regulate. It's sort of like if someone said to you, hey, you got to give your oldest child an extra 15 grand. You may not have to go out and get another job to do it, but you may have the money in the bank, but it's still a costly allocation. And so just to be very clear, both our mission statement and our vision statement refers to sound regulation. And I, like all of you, are committed to exactly that. So tomorrow, of course, we will have another open meeting to deliberate on the final cross-border rule. We'll also consider an order to exempt certain European entities from registering as swap execution facilities. So I hope everyone on this call will consider joining us tomorrow. And again, I just want to thank the DSIO staff in particular for their superb work. There being no further business, I'd entertain a motion to adjourn the meeting.
So moved.
Second.
Thank you. Those in favor of adjourning the meeting will say aye. Aye.
Aye.
Those opposed, no. Okay, the ayes have it. And again, I'm grateful for the CFTC staff for their great work. The meeting is hereby adjourned. Thank you all.
This concludes today's call. Thank you for your participation. You may disconnect at this time.